Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello, everyone. Good afternoon. Thank you all for spending some time with us and taking time out from your busy schedule to come here and listen to us. It means a lot to us. So I will just first introduce who we have with us on the stage. So we've got Rajeev Thakkar in the middle, who's the CIO of the fund. On his right is Raj Mehta. He's the fund manager. On the left, Rona Konkar, again fund manager. And Rukun next to him, Rukun Tarachandani. So the movie was 3 hours, but we've got 4 hours. All right. So again, a big thank you to Mr. Neil Burate, who's the Deputy Chief of Mint. Thank you, Neil, for doing this again for the second year running. We really appreciate it that you're moderating this session. Thank you so much again. And I am Neil Parikh, CEO of the mutual fund. Thank you. So before we start, I just need to say that viewers, listeners, and all other stakeholders should note that the objective of this meeting is to communicate with our unit holders and share with them our thought process. It should be noted that the views expressed here are based on information available in the public domain at this moment. Views expressed here can change depending on changes in circumstances. Nothing discussed here constitutes a buy, sell, hold recommendation, and mutual fund investments are subject to market risk. Read all scheme-related documents carefully. So we can finally start now. So for people who are new or who don't know a little bit about us, so we've just completed 10 years of our mutual fund journey. And thank you to all of you all to make that possible. So really appreciate that. So over the last 10 years, we had lots of ups. Ups have been there. There have been some downs in the beginning. So let me just quickly take people through the journey of PPFAS Mutual Fund. So this is our 10th AGM also. So thank you all for making that possible. So we launched the fund in 2013. We launched with a single scheme structure, and that was just one fund. And the specialty of that fund was that we could invest in Indian equities as well as foreign equities. Nobody actually had kind of a fund like that. So I would say we were kind of the pioneers in that 65-35 Indian and international stocks. So the beginning was a bit shaky for us because we started in 2013. Our founder, my father, Mr. Parag, then tragically he passed away in 2015, which was a big setback for us personally, obviously, and also for the firm and the organization, the mutual fund, because it was so new at that point. Again, that time the main thing was to survive. Make sure that we walk the talk. Whatever he had promised and whatever he wanted for the mutual fund, we wanted to continue going that way. And I hope we've done it over all these years. We crossed 1,000 crores only after more than 5 years, So it was a big struggle in the beginning. So in the first 5 years, we didn't cross 1,000 crores. Today, NFOs are like mopping 8,000-9,000 crores. So you can see the initial years was very much like a startup phase in the sense that we need to keep our costs in control. We make sure that things go on as smoothly without, any of our values or philosophies getting diluted, So that was a bit of a challenge, but I'm glad we went through that grind, I would say, that made us, I think, where we are today. A lot of humility with that too, Those days were pretty tough, I would say. We launched a second scheme, the Liquid Fund, in 2018. And after that, we launched 3 other schemes, So we launched the Parikh Tax Saver Fund, which is a only India equity fund. It doesn't have international stocks in it. And you also get tax benefits out of that, from the ELS category. In 2020, we were sitting on a decent amount of cash position, about 14 or 15%, about 13% cash position, which helped us when the pandemic came. Markets crashed. We were able to deploy money in meaningful way in in stocks that we thought was really there was opportunity in those stocks and they were available at a good valuation, so we could do that. We launched our fourth scheme, the Conservative Hybrid Fund, so that's kind of the debt fund from our stable, and that basically had a mix of equity, fixed income, 75% fixed income, up to 25% would be in equities and in REITs, InvITs, so that was kind of the making of the scheme, and actually that's done pretty well. There's obviously the recent tax changes have come, and that has lost the tax benefits of that, and we'll come to what the future plans of the fund are also on that. But that was the fourth fund, the Conservative Hybrid Fund, which was actually the debt fund from our side. And recently we launched the Arbitrage Fund. It's been a couple of months. It's again to take advantage for people in the higher tax brackets to use for short-term management of their money. You get better tax breaks for that. You're paying 15% short-term capital gains when you're doing arbitrage fund. But if you're in a higher tax brackets, in a liquid fund, you'll be taxed at your marginal rate. Also, last year, the foreign investments had been stopped by RBI. The limits had been hit of 7 billion of the whole industry, and we're not allowed to buy more foreign stocks as such, or we're not allowed to send more dollars to the US or wherever internationally. So that has stopped for the last 1.5 years, and there's no clarity on when that would reopen. So the interesting thing is a lot of people recently or even before would be like, why is this tortoise your logo? And some of the people would say the tortoise denotes something which is slow, but I want fast returns. I want to go fast in the markets. And why is the tortoise your mascot? So so it's a good time to explain everyone why we've chosen the tortoise as the mascot, and have we walked the talk, have you gone the tortoise way? So let me just also touch upon that a little bit. So the tortoise stands for longevity, hibernation, protection, and timelessness. So let us see what we've done and what do we stand for when we talk about each of these things. So first is longevity. So just as the tortoise stands for longevity, at PPFAS Mutual Fund, we invest for the long term and are unaffected by the short-term vicissitudes of the market. So in the shorter run, things can go up, down, a little bit crazy, So but we are very much focused on the long term. We don't do anything just to make a quick buck here or there, or because somebody else is doing it, we need to do it. No, we stick to what we understand, and our preferred way is to buy and hold and let those businesses perform. So there's no alternative to long-term thinking and patience. If you want to make wealth in the markets, I think there's only two things you need: patience and long-term thinking. And hopefully leave the fund management to these guys, and I think we should be pretty good. Again, we always talk about the law of the farm. You cannot sow something today and reap tomorrow. So just as a seed has to go through various seasons, has to go through long years till it becomes a full-grown tree, same is the principle with our investment. You might get lucky once or twice doing something in the short run, or do something trading or something like that. But if you want a consistent way to make wealth, then there's no other way than to look at it from a long-term perspective. So we are very much like the tortoise, believe in the longevity of our investments. Just as a tortoise hibernates in winter only to emerge rejuvenated, we too believe in acting only when the time is right, and lying low at other times, as mindless action can often work against the best. So one here the one thing is that the cash positions that we have sometimes, and we don't force ourselves to be invested at all times. If the opportunities are not available, then we rather hold back and stay in cash and wait for the right opportunities to come. So this is the chart of our cash position over the years. So we've gone to almost 30% cash in about 2017-18, when we didn't find, when small caps and mid caps at that time were just going one way. Opportunities were not available that easily. We thought, okay, let's wait it out, and only when opportunities are ripe will we invest in those. So again, opportunities did come after. You see that we've been able to get that cash position down pretty quickly in the next 1-2 years. I mean, things happened, some debt crisis happened, COVID hit, and we were able to really able to invest money at good valuations, and that has really helped over the longer term. So with this, what happens with cash, sometimes you would see a short-term underperformance in the fund, if markets are going one way and we are holding cash. But I think over the longer term, we've seen that, there's no other alternative than to get into investments at a good price. Starting valuations do matter. So we don't chase stocks. So the next one is the protection. Just as the hard shell protects the tortoise, we too believe in protecting the capital of investors. I think this is a very big thing for us. I think more than the returns, we'll look at risk a lot more. I think if we can control the risk of the portfolio, I think, and give a reasonable return, then over a longer term, you can have a portfolio which has low risk and high return. So the risk versus the category. Our category is the Flexi Cap category. The Flexi Cap category, so when you compare our fund with other funds in the category, we have very low risk. And again, the return versus the category are high. So that's kind of what we want, and what I think everyone wants from the investment, right? Low risk, high return. I mean, so that's what we kind of aim to do, over the longer term. Again, this is the chart from Morningstar. It's not our chart. It's the source's Morningstar. And the interesting thing is this upside downside capture ratio you see on the left of me and right for y'all. What does that upside and downside capture ratio mean? Okay, so the upside capture ratio means that if the index goes up by 100, the category, the Flexi Cap category, and the index would be the Nifty 500, the category will go up by 97, and we will only go up by 84. So we don't catch all the upside when the markets are rising. We will underperform when markets are in a tearaway bull market. So if the category is 97, we'll give 84. Now the downside protection is actually pretty interesting there. So it says that if the index, the Nifty 500 goes down by 100, the category will go down by 91. So all the Flexi Cap category will go down by 91. We will only go down by 45. Okay, so even though we don't capture all the upside, the downside is well captured and it's well protected. And once we can do that and give a reasonable return, I think over a longer term, I think you will have a portfolio which is not very volatile and will give you some decent returns. So we've been able to manage that since till now, and we hope going forward that we'll be able to do that too. Yeah, sorry. And the last one is the timelessness, as the tortoise symbolizes timelessness, at PPFA, we believe that the principle of sound investing is etched in stone and will not lose their relevance with the onslaught of new fads and fancies that keep coming in the market from time to time. So a lot of times, for us, we have a very set process in place, and there are things that are important to us when we invest. So one is partnering with minority shareholder friendly management. I think when you're investing, it's important to invest with good management, and that's our number one priority. If someone is dishonest, then unfortunately, we've seen over time that shareholders lose out big time. So we put a lot of focus on the management quality. We want to partner with businesses and not merely purchasing stocks. So we want to just buy something that we think will go up tomorrow or day after, but we are looking at business prospects. So as long as the business prospects of the company are good and we have a long-term view on the company, thinking that this is the right way of the companies in the right direction and over a longer term can perform well, then we'll want to partner with them and go along with the journey with them. So we're not here to trade, we're here to invest. We prefer purchasing cash generating low debt businesses. So having cash in your books is good when times are bad. You saw in COVID time when companies had cash on their books, they were able to buy out other companies or make acquisitions. But those companies which had a high debt, they unfortunately, some of them had to go into liquidation because they had to pay off their debts. So we don't prefer very high debt companies. We like business with a strong moat or a competitive advantage. So again, if you can get a company which has a monopoly, duopoly kind of characteristics, we would really like that. So those are kind of companies we want where it's not very commoditized. It's there's pricing power in those businesses. And last is we want to avoid overpaying. We purchase with a margin of safety, and we purchase when things make sense. We're not chasing stocks. The starting valuations matter a lot when you buy a stock. So these are some of the things that we concentrate on. So we have 5 schemes right now. I've spoken about that. Flexi Cap, Tax Saver, Conservative Hybrid, Liquid Fund, and recently the Arbitrage Fund. So so the journey ahead. So I think one thing we realized, there's a gap in the portfolio where what Conservative Hybrid Fund did, so it's a great product for us, I mean, we think it's a really great product, but it doesn't, because it cannot go up to 35% in equities, it loses the tax benefits, the tax benefits for that. So one thing we're going to do is come up with another scheme. We are just figuring out which category it's going to come out, which we are going to launch it in. But it'll be somewhere on the lines of Conservative Hybrid Fund where the equity position will be 35%. So you will get indexation benefits for that, So we're in the process, so you can expect another scheme launched from our stable. Again, no clarity on foreign investments right now. The talks keep going on. We keep asking. We've written letters also to AMFI to talk to RBI and stuff. But right now, there's no clarity. We are hoping it happens sooner than later. But as of right now, there's no update on the same. Again, a lot of our focus was on digital enhancements. So one of the peeves of our distributors were that there's no partners app. So now that's up and running. Also, the self-invest app was going through some issues last year, but all that is solved, and I think now it's going smoothly. So I think you can expect the digital enhancement to happen. Again, one of the things we are thinking about and we are working on it is Insta redemption in liquid funds. So basically up to a certain amount of money, you'll be able to instantly redeem your liquid funds, and you'll get the money in your bank in 30 minutes. So it's kind of like a debit card kind of a thing, So so this is a feature we're looking at. I think a lot of people have even asked us for that. So hopefully that we can get that also through, and we'll announce it when that happens. This is the so we are in 17 locations now other than Mumbai. We've got branch offices in Ahmedabad, Bengaluru, Chennai, Chandigarh, Gurgaon, Hyderabad, Kolkata, New Delhi, Pune and Vadodara. Our representative offices or representatives are at Lucknow, Kochi, Jaipur, Nasik, Rajkot, Surat, Bhopal, and we'll be expanding this on a yearly basis. So hopefully next year a lot more branches would be formed, and a lot more we'll have feet on the street at a lot more locations. So currently we've got 31 lakh unique folios or unique customers. The AUM as of 26 November was close to 54,000 crores. And we've got about close to 38,500 distributors empaneled with us. So I think we're pretty happy with the numbers here. Yeah, so I think that's kind of about the fund. And, I realized that we've got a lot of new clients, young clients. Also, we're in the midst of a bull market also. So I think I just want to just leave a thought, or something that we think is very important for people to understand is that, can you delay instant gratification, So the inability to delay instant gratification is the root cause of all financial problems. And why it's so tough to do? Why can't we not delay the gratification and wait for a very long time? Is because that human beings generally do what is fast and easy versus what is necessary. So if you want to lose weight, go to the and make a good body, you need to go to the gym, and it's overnight. You're not going to get a good body. You're going to lose weight, right? It takes months or years for that to happen. But today you will see people on crash diets, or they will go for surgery or whatnot, to take shortcuts, So generally human beings are lazy and human beings are greedy, and we all are. That's the nature of human beings. And greedy is because if I offer you an 8-inch pizza and a 12-inch pizza, and I say both are the same cost, which one would you choose? I think most people will choose the 12-inch pizza, even though they cannot finish a 12-inch pizza, is because you're getting at the same price, you're getting both the pizzas. So we are greedy. We're generally greedy, right? So when you're greedy, you probably take more risk with that. So and cause and effect, right? If I clap my hand, when my hand touches my other hand, a noise comes. So we want something instant, right? We live also in a world where you get instant Maggie and instant noodles, and everything is instant. Everything's a click of a button. So we're tuned to that. We want everything instant. So when we say, your investments are for 5+ years and all that stuff, sometimes when things are very bullish, people don't take us seriously, or they don't take this seriously because they want something immediate, So they lose patience, get bored easily. We are always looking for excitement and new things, We saw that with crypto. We saw with a lot of other things, that people are always looking for the new and all, which is very exciting. But in the longer term, it gives you short-term gain, but long-term, it gives a lot of pain. But we need to do the exact opposite. Sometimes it's okay to take some short-term pain, but for the longer term, it's very good. You'll gain a lot over the longer term, and temperamentally, it'll be very good for you. So that's why people, I think today also, a lot of people we see are day trading, option trading. The simple fact is that if you do that, by the end of the day, you know exactly what you made or lost, right? And that's why investing is so hard, because you invest today, and we're all saying, okay, minimum 5-year investment. Look at it from a multi-decadal thing or something like that. Very hard for people to get that in their head sometimes, But honestly, this is the only way. And this is the only way where you can actually make wealth. So you can get lucky, you can get rich by going to a casino or gambling somewhere or speculating or something like that. But it's not a long-term strategy to make wealth. So I just want to leave you with that. To make wealth, you need patience, and you need a lot of discipline. And if we have that too, I think over the longer term, there's enough wealth to be made for all of us. So thank you, everyone. I'll call Rajeev now. Rajeev has a presentation also made for you all. So we'll get to that presentation and then we'll go into Q&A. So Rajeev, floor is all yours.
Good evening. Thank you so much for spending your time with us, both in person and people who are joining us online. Thank you for your presence, and thank you so much for the trust that you put in us. It's overwhelming, and thank you for the love, affection that you have given us, the trust that you have given us with the investments, and the time that you give us each year in terms of listening to the communication that we have. Almost every organization has some sort of a mission statement. So why have I put this in the slide? The reason why this statement is here, and especially this year, is that it will be used to answer a lot of questions that are there. And this will lay the foundation for the discussion today. So I'll take a minute to read this out for you. Our mission is to help clients achieve their long-term financial goals through prudent fund management. Apart from what is said here, it is also important to realize what is not said here. Our mission is not to be the highest return generating fund. Our mission is not to be the largest fund. None of those are mentioned in this mission statement. It is just to help people achieve their financial goals. That is one. And second is prudent fund management. It is not, as people aspire to do, the number one fund or the best fund or the highest return funds. That is not what we stand for. Again, why has SEBI given us this license, or why does PPFAS as an organization exist? Today, when we are hopefully helping 25 lakh customers to go towards their financial goals, that seems like a large number, but we are in the country of 140 crore people. So it's not that we are here to just help a tiny set of people reach their financial goals. We are here for everybody, and we have said this for a long time. So Parag bhai also has repeated this number of times. Our objective is to make HNIs, right? That is the purpose of a investment manager. It is not just to chase people who are already wealthy and to generally walk their dogs and be nice to them. That is not what we are there for. So people keep asking us, when are you closing for fresh inflows? When will you stop taking more money? People are afraid about the size of assets that the mutual fund industry has garnered. Let me put that as in context. So we have around 4 crore unique investors who are investing with mutual funds today. In a country with 140 crore people, what if that number from 4 goes to 40? We have so many unlisted companies which are yet to get listed and raise capital from the public markets. So it's a long journey. We are at the beginning of the financialization journey for a young and developing country in that sense. So, Neil, who's moderating the Q&A, will probably agree. I would think roughly 2/3 of the questions this year have been on the AUM. So if we just address this one question for till, let's say, about 7 o'clock, and half an hour we spent for other questions, we should be more or less fine, which is quite surprising. So after I saw the questions, I had to go back to our fact sheet and see what is it that our AUM is exactly. Did we cross SBI mutual fund to become the largest mutual fund house in the country or something while I was not noticing? No, that hasn't happened. SBI is still roughly 16 to 18 times our size, but we are special in the eyes of unit holders. We keep getting us this question again and again. And again, the interesting data point for people who are new, we've been asked this question since we were 800 crores of assets. At that time, the question was, will you shut for fresh investments when you reach 2000 crores? So again, this is interesting to keep in mind. We will surely answer questions on AUM. So we'll get to that, but be patient. There is something which is more worrying to me at this point in time. And that worry is around the expectations that people have in general, equity investors in the marketplace, and a small set of even PPFAS investors, and which is really scary to me. Those things are not very, very healthy. So I'll spend some time on talking about the expectations and aspirations, and why is it necessary to help align the expectations that you have as either clients or distributor partners or advisors, and what is it that we can actually deliver. So let's draw an analogy to food. Let us say you go on the internet and you search for good restaurants in a particular city. Now, one particular restaurant has been getting rave reviews from almost everybody. It is maybe rated 4.5 stars out of possible 5 stars rating for, and they are rated well in terms of food quality, hygiene, ambience, service levels, pricing. They are rated well on all these parameters. Now, if there is no matching of expectations, you could go to that restaurant and still have a very, very bad experience. Now, let us say that restaurant is a ODP restaurant serving the best dosas in the city. Whereas if you are in the mood for sushi, and if you go to that restaurant, you will come out disappointed, right? Now, that is the reason why we keep talking about alignment of interests. There are clients who are unhappy with us today because our returns, someone has said it's not the best in the category, someone has said it is underperforming, someone has said it is not giving as much return as small and mid-cap funds. Now, the next statement I'm making is not out of arrogance, it is out of pure humility. If you are not happy with the returns that you are seeing on a trailing basis right now, it is almost guaranteed that you will never be happy with the returns that the fund is going to generate. Future will have periods of volatility, it will have periods of flat returns, there will be periods of negative returns, there will be periods of underperformance. So, people who have come into the equity markets in last 2 years, 3 years, and who haven't seen a cycle, don't have that expectations right. One of the persons we used to follow very, very closely passed away recently, Mr. Charlie Munger. So we pay homage to Charlie Munger today in our meeting. And one of the statements that he would often repeat was that the secret to happiness in life is to have low expectations. Assume you expect 9% returns and you end up generating 12%, you will be very happy. But if your expectation is 20%, then even if you end up achieving 15, you will be unhappy in that kind of a scenario. This is a formula that seems familiar. This is a formula we have studied in high school, right? Even if you have not done finance, you should have come across this formula, unless you gave this chapter a skip and somehow managed to pass school, you would know about this. So on the left-hand side, you see A, which is the amount after a certain period of time. On the right-hand side, you have P, which stands for the principal amount that you have invested. 1 is obvious, it's the numeral 1. R is the rate of return that you will generate. It could be the bank FD rate or it could be equity returns. This is determined and this is denoted in decimal points. So 10% will be 0.10. And raised to n, so this n is the number of years that you remain invested in that investment. The interesting part about this formula is that out of the 4 variables that are mentioned there, A, P, R and N, 3 variables have got to do with you as investors. We have nothing to do with those things. How long you stay invested is determined by the investor. How much you save is determined by you. How much you need for your financial goals, A, is determined by you. We have no role to play over here. The only partial role that we play is in R. And again, I mentioned partial role. It's not fully in our control, and I'll come to that. So, A for aspiration. Do you need a Hyundai or a Rolls-Royce to commute? That is determined by you. I have no role to play here. If you let your aspirations run wild, that is on you. How much can you save, either as a lump sum in retirement or periodic monthly savings? That again is completely on you. The more you save each month, the more your corpus will be at the end of the period. And N refers to how long can you remain invested, what is the patience that you have. Neil referred to delayed gratification. This is about delayed gratification. If you invest today and in 6 months you feel the itch to redeem that money and buy something, then that is not going to create sustained wealth for you. So this is all I have to say about these 3 variables. The most important variable in the questions that we have received is R, and we will jump onto that. Before I go there, in the data that we get from our registrars, CAMs, I noticed a very, very interesting trend. So what I realize is that there are 2 kinds of investors in PPFAS. The people who are redeeming equity units with us, the average holding period of their investments with PPFAS, surprisingly, is lower than market average. So people are coming in and going out at a faster pace. This is despite the exit load for the first 2 years, and this partially explains why we have exit load. It is to discourage people who come in and go out. So this is one set of investor. The other set of investor, people who remain invested, are invested with us far greater than the market average. So the longer term investors with us are really long term. They have maybe 2 times, 3 times the holding period with us. They don't feel the need to redeem at all, and they are participating in the compounding journey. And there are some people who are quickly investing and quickly redeeming. So which was surprising to us. The first kind of investor, to my mind, there's a mismatch of expectations. That is the kind of investor we don't want to encourage, and it's for those people that we have this exit load for the 2-year period in Flexi Cap, and in tax saver anyway there's a lock-in, so you are anyway invested for the long run. So let's come to returns. Show of hands, people who invest with Flexi Cap, how many people expect less than 8% return? Anyone? Okay, one person in the entire hall. Okay. Between 8 and 12, show of hands, quite a few. Okay, that's very, very encouraging. 12 to 15, again, quite a few. 15 to 20, okay, there are maybe 10-15%. Above 20%, okay, there are a few people who are about 20 as well. So, let me share some bad news for people who expect about 20%, at least in terms of the base rates that are there. I don't know what the future returns will be. So, irrespective of which category you raised your hand, the returns achieved by all of you will be exactly the same, since it's a mutual fund. So, there's no there's no penalty for wrong answers, and there's no prize to be given for the right answer. And the answer is also unknown as of now, because mutual fund is anyway a risk product. But let me give you some reality check on this. I'll move around a bit and I'll pick up the hand mic. So these days, mutual fund websites have started giving very, very interesting data. These are called rolling return data points. So the next 3 slides that I'll be sharing are from Prime Investor, but you could use Prime Investor, you could use other sites as well, let's say a premium subscription of Value Research, or maybe Advisor Coach, or there are plenty of sites which give you rolling returns. Now let's leave aside the Flexi Cap for a minute. Let's just look at the Nifty returns in the last, and this is the most popular Nifty ETF that is there, and the longest surviving one. This is the Nifty Bs that has been around for a while now. The average 10-year rolling return for Nifty Bs has been 11.78%. 10-year rolling return. So this is sub 12. And this is this includes dividends, this includes expense ratio. The only extra cost that you would incur is the demat charges and the brokerage that you would pay for the buying and selling of the units. Apart from the average return, interesting point is the maximum return 10-year period has been 17.67% per annum, and the lowest return has been 4.95% per annum. So when I said 5 to 8, it was not a trick question. There has been a 10-year period where investing in Nifty for 10 years, you would have got sub 5% returns. Equity returns are not guaranteed. There are a few people in this room who have sufficient grey hair and who were investing in the 90s, who have seen a 11-year period where Nifty was not existing in early 90s. 1992 to 2003, you had a 11-year period where Sensex gave you negative returns. So, firstly, equity is not a guaranteed return product, and returns can bounce around quite a bit, number 2. And number 3, on social media, I've heard people talking about 20% returns and 30% returns and 40% returns and all kinds of things. The base rates don't bear out those kind of expectations. Again, important point to note is the 11.78% number. A lot of people go with a 15% number, saying 15% has been the average equity return in the past, which, see, in statistics it is said that if you torture data long enough, it will admit to whatever you want it to admit. If you increase the look back period, if you include 90s and all, you will get higher numbers. In the 90s and early 2000s, equity returns were higher purely because inflation rates were higher, bank deposit rates were higher. Now, when you had close to double-digit inflation numbers, a 15% equity return would be possible in such a era. But today, when inflation is far lower, when interest rates are far lower, using those same expected returns, to my mind, is fraught with risk. This is the last 15 odd years data, or 15-18 year data, sub 12% return at the index level. I'm not talking about our scheme here at all. I'm talking about Nifty. This is 5-year return, Nifty rolling. Not much to see here. Let's go to the 1-year return, which is more interesting. If you invest in equity with just a 1-year horizon, you will achieve less than 5% return almost 30% of the time. Let that sink in. 30% of the time, maybe 1 in 3 years, you will either get negative or 0 to 5. Your bank FD will do better. People keep asking us, why do you have exit load? Exit load money does not come to us as an AMC. Exit load is plowed back to remaining unit holders. But anyone who is even slightly worried about the exit load should not come to us, should not invest with us at all, because then that investment is not suitable for equity investing. There are plenty of good fixed income products which are there, which are suitable for 1-year kind of investment horizons. So this is about the base rates as far as Nifty returns go. People say, oh, but this is Nifty. Active funds should do better. I don't know about other fund managers, but at least I don't have a magic wand which, if Nifty is giving you less than 12, I'll give you 40%. I don't have any such method. And if I had, then bad news for Neil, I would then retire. I would just run my own money if I could generate 40% each year without any risk. I don't need to work anymore then. And when you invest with active funds, you need to give them sufficient time even to find out whether they are underperforming or outperforming, because there will be years where they will underperform. They should stick to a well-defined strategy and hope to outperform the index. But again, that is not guaranteed. If you go for active funds, there is a possibility you could underperform as well. So just shifting from passive to active again is not a sure shot formula of making extra normal or outsized equity returns. Finally, we come to the burning question of the day. After you have become so big, how will you outperform? And people catch on to the first line. Could we just remove the video on the top? Yeah. People just refer to the first line, which has been said by Warren Buffett, no less. And they say, okay, size is anchor of performance. PPFAS AUM has gone up. So now what is the plan? So let me actually read out what Warren Buffett actually said. It's a paragraph rather than just picking up one line from what he has said. This is what he had said, I believe, in 1984. Just let me recheck that. Yes, 1984 is when he said this. This was in a speech at Columbia University. And the title of his talk was Super Investors of Graham and Dodwell. Those of you who have a copy of The Intelligent Investor, it's there as a appendix in that book. I'll just read out this small paragraph. He mentioned this in the context of Bill Rowan, who is one of the super investors as per him, and where he had recommended people to invest. He said, size is the anchor of performance. There is no question about it. It doesn't mean you can't do better than the average when you get larger. But the margin shrinks. And if you ever get so, you are managing $2 trillion, and that happens to be the amount of total equity evaluation in the economy, don't think you will do better than the average. So firstly, it was mentioned as a praise for Bill Rowan, who could outperform despite managing slightly larger amount of money. And he did not put any sliding scale that at this AUM you will stop underperforming. There's no number that is given. The only number that I could find is $2 trillion, and we are well short of that as of now, right, Rukun? Yeah. So I'll address size. So I've written a note to unit holders that has a lot of tables and annexures. So people who haven't read it and are very, very keen on the size question can probably refer to that note that we have sent out. Nevertheless, I'll share some data points today as well. This photograph was clicked at a media event. Business Standard Summit was there. And you see the photo on the screen. The shortest person on stage is me. And the person with the smallest AUM also is me on screen. Okay, so the moderator for this event was Mr. Tamal Bandopadhyay. And he was just adding up the AUM of all the panel participants. His point was, this panel represents more than 50% of the mutual fund AUM of the entire industry. So he started with SBI mutual fund, how much? He gave some number, 8 lakh crores or 9 lakh crores, etc. He was going around. I was the only person who gave decimal point answer, 0.5. Everyone was saying 9 lakh, 6 lakh, 4 lakh and those kind of numbers. So with or without me in the panel, the number would have been the same, 50% of the industry AUM. And still, the AUM question is reserved for me. No one else, to my knowledge, gets asked this question on AUM. We are roughly 1% of the industry AUM. In equity, so people say, okay, you are not in liquid funds, you are not in passive, so talk about equity fund, leave aside everything else. In equity, we are about 1.75%. Even there, it's not a big number. And mind you, this is of active equity AUM. We are not including passive here. Apart from mutual funds, all the AMCs have some sort of a PMS or a AIF business, or they have a NPS managing subsidiary, or they are managing offshore funds or advising offshore funds. We have none of that. Still, it's not a very, very large percentage. And over and above this, mutual funds are again not the only investors in town. You have insurance companies, you have FPIs and PMSs, AIFs, all sorts of other participants are there. Retail investors are there. So one has to keep it in context. We have been repeatedly saying this from day one, I think for last 10 years, that What matters is AUM at the fund house level and not at the scheme level. No mutual fund house can own more than 10% of the outstanding capital of any company. It does not matter how many schemes that you run. If, let's say, someday the largest fund house gets to a size where they would have to own more than 10% of, let's say, TCS, Reliance, SBI and all that, then barring a change in regulation, they have to stop for fresh inflows. They cannot take more money. This is across passive and active schemes as the law stands today. So I just joke with Neil that maybe we should do like companies do demergers, they split different divisions. We should do a demerger of our Flexi Cap. We should give free units of a small cap fund, mid cap fund, Pharma fund, auto fund and all that. If the scheme gets divided into 10 schemes, automatically the AUM comes down to whatever 4,000-5,000 crores and this question will go away. So we have been maintaining this. What matters is what is the total equity AUM rather than per scheme AUM. So that brings us to the other question. Now, 2/3 of the questions were on AUM. Rest 10-15% of the questions were on small cap. Why? How will you invest in small cap? Why have you not invested in small cap? And all sorts of things. So, based on last available data, we are right now roughly 13-14% invested in the small and mid cap space of the overall AUM that we have. It's not that we are not investing in that space. We do have investments in that space. Rukun has done a presentation on the small and mid cap space, which is there on our YouTube channel. You could look that up if you are interested in that. It is our belief that today is not the best time to be increasing allocations there. But as and when the opportunity arises, we will definitely be looking to invest in that space. But people who think that just by investing in small and mid caps, you will achieve outsized returns, that again is not the formula. So just a few years back, there were these Hrithik stocks and Salman stocks which were there. These are acronyms. So HDFC, Reliance, Infosys, TCS and those kind of acronyms were made. At that time, the complaint was that, oh, it's a rigged market. Our stocks are not going up. Only the large caps are going up. For those of you who believe that investing in small and mid caps is the sure shot formula to make outsized returns, I would just urge you to look at what has happened in the US markets this last 12 months, 24 months. Over there, just like we had the Hrithik and Salman stocks acronyms, in the US markets, there are stocks which are called Magnificent Seven. This is the way it looks like. So, on the chart on the right, the plus 71% that you see is the performance of those 7 stocks. The S&P 500 is up by around 19%. And rest of the stocks have barely given any return whatsoever. So today, the small and mid-cap investors in the US are crying. They are regretting not investing in the largest 7 companies and investing in the broader market. So there's no guarantee that just because you invest in small cap funds or large cap or mid cap funds that you will achieve outsized equity returns. A valid question when people ask us about our AUM is that in the small and mid cap space, we will not be able to buy very, very large quantities relative to our AUM, and our own buying selling could have some sort of an impact cost. So the answer to this is, think of these Russian dolls, Matryoshka dolls as they are called, where there's a doll inside a doll. Think of the Flexi Cap fund as a fund which encompasses a small cap fund within itself. It's not external to the fund. So in the small cap space, we can invest in a larger number of companies. The top names will look very, very similar to the way they are. But when it comes to smaller companies, we will not hesitate to invest in the company if it looks promising, just because it will add to the number of stocks that we own. So you will see slightly larger number of stocks in the small cap space or maybe in the mid cap space. Neil already spoke about this. So I'll just briefly mention something on the conservative hybrid. So a lot of people have been asking us, why don't you change the conservative hybrid fund itself? So it is not permissible as per regulation. So the SEBI circular on categorization of mutual fund schemes has a cap of 25% equity in this category. So we cannot go beyond that. So to have a scheme with indexation benefit, we'll have to come out with something in a different category. So this is all that I had to share today. Maybe I took 5 minutes more than allocated. We'll jump into questions. Thank you so much.
Yeah, that's really exciting. We can take questions that have come. And post that, I think we can open the audience so there are some more questions on that.
Kind of interesting. Last year, when the Flexi Cap scheme was underperforming, the room was half full. Now it is stock drop overs, and then the notation is also. So before I get into the introduction and my questions, let me quickly introduce myself. I am Neil Borate. I am Deputy Editor at Mint, where I head the personal finance team. Some of you know us better by our website, which is livemint.com. Many parallels are drawn between this event and the Berkshire Hathaway AGM, and between PPFAS and Berkshire Hathaway. One interesting parallel that some of you might not know is that if you look at the return that Berkshire Hathaway gave from 1965 to 2022, that was 20% compounded. It's rather uncanny. The return since inception of PPFAS Flexi Cap is almost 20% compounded. Now, unfortunately, I wasn't an investor in this scheme at inception. I'm kicking myself for that. But I have been an investor in this scheme since 2020. And I suspect a lot of the people here in this room are also more recent investors. And our returns have not been bad either. So when Rajeev asked about return expectations, I put up my hand for 12%. I'm a deeply pessimistic person, and so I don't even expect alpha. I just say the index return. But the return over the past 3 years has been 23%. The return over the past 1 year has been 27%. Of course, I don't expect these kind of returns, but it's lovely to be positively surprised. So let's give them a hand for... But at the same time, it is not returns that sets Parag Parikh mutual fund apart. I would say that it is a couple of other factors. Number one is their refusal to launch scheme after scheme to garner AUM, to go for marketing NFOs, to go for all kinds of things to garner AUM. They've been steadfast in launching as few schemes as is technically possible. And their willingness to answer questions in an event like this. Questions from unit holders, regardless of the size of our investments. You can have one unit and you can come here and you can ask your questions. And that, I think, really sets them apart. Rajeev spoke about size. Just a small tidbit. So I think the Flexi Cap scheme is now India's second largest actively managed fund. And I suspect it will soon be India's largest actively managed fund. So again, a big thank you to all of you. And now we can get on with the grilling. So I'll prioritize the stock-specific questions. And we shall begin with ITC. So this is for Raj. What is your view on ITC from here, given that the stock has performed well over the past couple of years and is unlikely to repeat the same? Are you holding it purely for dividends? And what is your opinion? What will growth drivers be for the company from here on?
Sure. So last year or 2 years back, there were a different set of questions for the same stock. But yeah, definitely it's doubled in like 18 months and 6 months of underperformance, and the questions come back again. So nothing changes from a business point of view. The company continues to perform well on the FMCG side, which we expected them to do on the margins front and on the revenues front. As they have announced, they will be demerging their hotels business, and that frees up some cash flows for the company, which will be, the resulting company, not the demerged company. And valuations wise, we think that it's in the reasonable zone. So it's not expensive, it's not cheap. So we have not been adding, we have not been selling. Whatever we have, we have not been selling since about 2 years, or we have not been adding since about 2 years. So we keep on holding on to it, and hopefully the business continues to perform well.
So let me add something here. Anyone who creates a startup seems very, very exciting and sexy, right? People rush to hand over money to them. They start commanding premium valuations. So here we are talking about a company which was a cigarette company only, or cigarette and a few other businesses, hotels, paper boards and stuff like that. And more than a decade back, they said, we will get into the startup phase. Although they did not use the word startup, they should have probably. But they said, we will create an entire new FMCG company within this. We will get into biscuits, we'll get into soaps, shampoos, ready to eat, things like atta and stuff, chocolates, whatnot. Now, people know that startups have to incur losses in the initial years. And this company made losses because they were setting up a new business. Today, cigarettes contribute less than half the turnover of the company. And they are actually preparing for a world where hopefully tobacco is not there and people move on from tobacco. They are preparing for that day someday. And if it's listed and if it's profit making, then there's no charm in investing in a startup. That's the way people look at it. Here we look at it, that at least that portion as a startup where they have picked up volume share, market share. So in a lot of categories, they are actually number 2 or number 1 or number 3. And currently the margins may not be equivalent to the margins of the top players. So for example, in noodles, they wouldn't have margins nowhere close to something like that of a Nestle. But nevertheless, they have gained market share and are there in the top maybe 3 or 4 players there.
The next question is, what is the rationale behind holding Coal India and NMDC in the portfolio? Is the petroleum sector, the government decided to retain profits by levying windfall taxes. So what makes you confident that this will not repeat in any of the PSU companies in your portfolio? This is for Rukun.
So windfall taxes can be levied anytime by government in India or even internationally. Internationally also, there have been cases where windfall taxes have been levied. We are ambivalent in terms of partnering with the government. So at one end, government has multiple objectives. So they have customer interests in mind. They have the interests of the employees in mind. They have national interests, and shareholder profits are just one among many competing objectives that they have. At the same time, they have these strict processes in terms of CAG audit and robust tendering process, and sometimes, in fact, it becomes too cumbersome, but at least there are mechanisms to stop leakages and things like that. And the another advantage that these companies have is many times they were erstwhile monopoly operators in their area, and they have been given mineral rights or environmental clearances and things like that, which are very, very difficult for a newer player to get these days. So specifically the two companies you spoke about, at the time when we bought them, the valuations were very, very inexpensive, and in our mind, the risk reward was in favor of investments rather than in favor of avoiding them.
The next question is a related one. How is Coal India different from oil marketing companies in terms of investment potential?
So oil marketing companies more or less work on a fixed margin where they buy refined products and then they have to sell the products through their chain of petrol pumps and things like that. Coal India, to that extent, is more of what is referred to as a primary commodity producer. So primary commodity producers are people who actually dig up the ground and extract something, and typically they are more vulnerable to the up and down cycles. So ONGC is affected by the up and down in crude oil price, whereas HPCL, BPCL really would work at the margin. They would earn a margin between the price of crude that they procure. They would split the crude into the refined products and then they would sell it through their distribution chain. So typically the riskiness in the secondary commodity producers is lower. However, in India, the different thing is that given that most of Coal India's products are sold at a regulated price, that up and down in the global coal price does not flow through to the profits of Coal India, given that they sell only a small portion of their produce at market determined prices.
Your rationale for investing in Infosys?
So IT services in India has had a very long runway of operations, and within that, most of these companies, Infosys included, have had over 35-40 years of operating experience. And what they have done is, at every change of technology that has happened, where their customers, which are other companies, so for example, a retail company might want to adopt technology, a FMCG company would want to adopt technology, and so on, a bank would want to adopt. At every step of technology change, they have been providing services to people who want to adopt technology. And the model has been very simple. We have trained engineers in India. They are able to provide these services at a cheaper cost compared to the same engineer in that country. Also, number of engineers available here is much larger. So if you can do some work remotely, that also works out in favor of the companies which are running in India. So that model has been in existence for multiple decades. What happened is, over a period of time, the expertise, the scale of these companies have gone into different verticals. So they just don't cater to one single vertical. They cater to a variety of different sectors. So like I mentioned, banking, retail, manufacturing, could be other variety of sectors as well. So investing in larger IT services companies like say Infosys or even a TCS, Wipro, HCL Tech, the reason is that you get a variety of verticals exposure.
You also get the age-old business model where the technology adoption continues to happen, but there has to be some vendor who will help you in adopting technology, because not every customer will have skilled people on their payroll at that scale to deploy it across their global operations. So larger companies get a benefit of that. Also, being in India is a operating leverage for them because they can generate more profits because the cost of employees is way different even today, even despite this business model has been around for a very long time. So this IT industry's narrative has been the same over a period of time, and they have had a good track record of execution. They have had a good track record of cash flow generation. The payout of cash flow to shareholders also has been quite consistent and has been increasing over a period of time. So what we require in a company is company run by good quality management. They have demonstrated that over the past years of operation. We require companies who have good cash generation. They don't require outside capital or debt or borrowing to scale that business, and they can pay out that money back to the shareholders. At the same time, the valuation should be reasonable. So all these things matter to us, which were available in some of these stocks, and that's why we own Infosys and like companies.
So the next question is about missing out on some of the hot sectors of present. Why have we missed out on investing in sectors such as infra, EVs, cap goods, rail, defense? And how do you view them currently?
Sure, I'll take that. So different investors have different styles of investing, and we are not saying one style is right, other is wrong, or things like that. Again, it's about alignment of expectations between investors and us. I gave the example of sushi and a dosa. So what is it that we stand for? We stand for investing in companies which have a track record. We need evidence. We will not invest based on something that people expect to happen. So in the sectors that you referred to, people talk about budgetary allocations, people talk about government policy, some people talk about order book or prospects. What we want to see is, we want to see execution, we want to see a track record of profitability. In a lot of these things, that track record is not there. And I have referred to some of these sectors or our investing framework in the note that I have sent to unit holders, and people can read that for context of why we are not investing in some of these sectors. I'll not comment so much on the current set of sectors or things like that, but let me take you back to the past. In the past, private sector airlines were considered to be a very, very attractive space to invest in. So my daughter, who's here, she was not even born when some of these airlines were set up, and they in fact shut shop before she was born. So you had Damania Airways, Modi Luft, East West Travel and Trade Links, you had Air Deccan, you had Jet Airways, Kingfisher Airlines, and so many airlines. So it was not a great experience for investors in those companies. Similarly, erstwhile monopolies were MTNL, BSNL in telecom. When private sector companies came into the mobile telephony space, that was considered to be a very, very promising sector to invest in. And people lost a lot of money in many of the companies. So what we do is, we don't take that risk. We will wait for the numbers to show up in the financials of the companies, and then if they are attractive, we will buy those. So in our portfolio, for example, there are some companies which are referred to as technology related companies, at least in the global space. So we have companies like Google, we have companies like Microsoft and Facebook. Now, at one point in time, these companies were startup-like companies. We did not invest in them at that point in time. We invested in them only after they started showing profits. Now, today, there are other companies, let's say something like a Uber or something. These look promising, and there is a lot of prospect that people talk about. But we are not invested in some of these where the profitability is yet to be seen in the financials. So, yeah, a long answer to a short question. Thanks.
The next question is for Neil. You said that you will not discontinue the conservative hybrid fund, but will you merge it with this new scheme that you're launching?
Hello.
Jamit.
Yeah, so one thing is we asked for permission to actually change the conservative hybrid into a scheme which gives indexation benefits, but we weren't allowed to do that. So we have to launch a new scheme in a category which will give these benefits. Going forward, if it's permissible to merge the two schemes, I think we could go ahead and do that. Yes.
Because that would be a non-taxable event. Otherwise, redemption would entail tax.
Yes.
Now you mentioned about exit loads, but there is one question on SIPs. So despite doing an SIP of 5 years, investors are subject to exit loads on investments made in the last 2 years of the SIP. Should there be a relaxation on that?
Yeah. So one is 10% of the total units are anyway outside the exit load. But in any case, if your financial goal is very close, then maybe you should not be doing SIP for the last 2 years. That would be my recommendation. And the exit load works on a first in, first out basis. So unless you are going to redeem all your units at the end of that SIP period, it wouldn't matter. So the typical experience, I would talk about it from my perspective. Let us say if I was saving in equity for retirement, the day I retire, I will not be redeeming all my equity units. It will be a gradual process. There would be something like a systematic withdrawal plan, and that would work on a first in, first out basis again. So for most people, I would think this problem should not be there, but in certain specific cases, it may make sense to stop the SIP 2 years prior to the planned redemption.
The next question is on some of the largest holdings in the FlexiCap scheme. An investor believes that HDFC Bank did well earlier, as did ICICI Bank and Axis Bank. As ICICI and Axis Bank were in turmoil, and hence gained some market share as well. Now that both these banks are performing well and valuation premium has also narrowed, in this context, why is it your top bet, and what could be the growth drivers going forward?
So we are invested in all three. So we are invested in HDFC, ICICI as well as Axis. All three are good. It's just that the run-up in something like ICICI has been far sharper than in HDFC Bank. And specifically in the case of HDFC Bank, I would think that the last 6 months earnings and the next 6 months would be a bit depressed as compared to the sustainable earnings, because all the costs in case of a merger come relatively quickly, and so these costs could be system integration costs, it could be rebranding of the erstwhile HDFC branches, or it could be regulatory costs like priority sector lending or CRR, SLR requirements and things like that. Whereas the benefits come with a certain amount of lag. So the repricing of deposits from a NBFC cost base to a banking cost base, these typically take time, as in when the earlier borrowings mature and then they reprice with the banking cost of funds, plus these synergies. All these take a longer period of time to come by. So here it's a bank which is barely above its pre-COVID levels. So the stock has not done much, and typically what we see is when something goes through a long period of a time correction and where valuations are attractive, things usually work out in the period ahead. But we'll see how things pan out, and we like all the three banks and we are owners in all the three.
Powergrid seems to be lacking aggression for renewables. What is your view of the same? Can you also explain why you prefer to invest in Powergrid directly versus transmission InvITs like Powergrid InvIT?
Sure. So, one has to recognize the business that Powergrid is in. It is in the business of transporting wholesale power from one place to the other. It is not so much in the business of generating power. So those are other companies who generate renewable energy, for example, renewable or hydro or thermal. It could be anything, nuclear power. What happens is with renewables becoming an increasing part of the overall energy basket, the requirement for grid investments increases because renewables are intermittent by nature. Sun may shine sometime, may not shine sometime, wind may be blowing, it may not be blowing. So there is certain amount of uncertainty and erratic generation in the renewable space. Now, because of which the grid has to be geared up to evacuate power from surplus regions to the shortfall regions. Now, grid has been opened up, the transmission business has been opened up for the private sector, but Powergrid, given its nature of a PSU and a AAA rating, they have the lowest cost of funds, and because of which they are able to generate better returns for shareholders. InvIT versus the company, so InvIT returns are more or less capped, where only the mature projects are transferred to the InvIT and then they taper out over a period of time, whereas Powergrid can bid for new projects and operationalize them and earn the surplus for equity shareholders. So I would think the company is a better business rather than just investing in the InvIT.
There seems to be news that the promoter in Cipla is looking to exit. In such an event, how do you view your holding in the company and how does it affect your thesis?
So thesis on pharma companies has been more or less the same. We build a basket of pharma companies which share common characteristics, and we buy only when there is an issue with the business or some news that is out there. The current news about Cipla trying to sell, well, we have to see who is the buyer, what is the price that they offer, and whether directors and shareholders of the company approve that particular deal. So we are awaiting that information. However, it's going to be a smaller percentage in the overall portfolio because it is part of the basket. As long as the valuations remain stable and within the reasonable range, then we can continue to hold on to business like Cipla.
What was the reason for exiting CAMS? Was it fundamental or valuation driven?
So CAMS was the investment we made a long time back. This was at the time of their IPO. Here we had got some allocation as an anchor investor, and we liked the business model and the valuation at which the IPO came out. However, the allocation that we got was a very small portion in the overall scheme, and it was not a meaningful position. So immediately on listing, the price shot up and we couldn't add to the existing position. So yeah, it was something which was not a very sizable position and we exited it. Not much thought went into it. On listing, it really shot up.
How do you manage default risk in the conservative hybrid fund?
So bulk of the investments in the conservative hybrid fund are in the sovereign papers where there's no default risk. The balance investments are in very, very highly rated certificates of deposits of banks where we are comfortable owning equity as well, leave aside debt. And again, the per company investments are managed at a low level, so we don't have excessive weightage in the investee companies. So because of that, we are pretty comfortable in terms of the credit quality that we have.
The next is a question I think you get every year, Rajeev. What is the business model of Maharashtra Scooters and how beneficial has it been to invest in Bajaj Holdings as compared to the underlying companies directly?
Yeah, so Maharashtra Scooters used to be one of the big holdings in Flexi Cap earlier. And it has been probably the one stock which contributed maximum in terms of the investment returns that we generated. It's a holding company. The erstwhile business has been shut down long back. Today it owns shares in Bajaj Group companies, namely Bajaj Finance, Bajaj Holdings, Bajaj Auto and Bajaj Finserv. And apart from that, it has some other money market and other investments. Over a period of time, the discounts of holding companies in India have been coming down. To that extent, we benefit from the additional upside that we get as compared to the performance of the underlying stocks. Also, the dividend yield on these companies is somewhat better than directly owning the underlying companies.
Yeah, and just to add here, when a mutual fund gets dividends, the fund does not pay any tax because it's a trust. So you as the investor, you do not pay any tax. If you directly hold the stocks, then you have to pay tax on the dividends that you get. The next question is, in general, the understanding was that when promoters draw salaries as high as 10% of profit, it is not a good sign. Keeping this in mind, how do you view the corporate governance in Balkrishna Industries and CCL Products?
So the salary where the promoters are also the managers, or where the business families own the companies, they tend to be a bit more generous to themselves than they would to maybe outside professional managers. But in these two companies, it's not something which is way off the charts. In fact, I would think that it would be more in the region of 5% or thereabouts in Balkrishna rather than 10% as the questioner is alluding to. I would prefer that the managers and promoters that we invest with, they pay themselves in a fair and transparent manner rather than do related party transactions or take out money in underhand ways. And as far as managerial compensation goes, these days there are these proxy advisory service companies which weigh in on that. Our own analysts do a due diligence on that. We compare the structures across the industry and we vote on all these resolutions. And how have we voted on these resolutions is also available on our website. So mutual funds as a group also weigh in on all these resolutions. It's not that the resolutions are passed mechanically. But in these two companies, I don't think there is any cause for concern per se.
Just one additional point here. So sometimes what happens is that there are multiple family members involved in the business. So when you add up each one's compensation, it looks higher. But if you look at individual compensation, it's okay. So in some family-run businesses have 2-3 family members involved in the business. So that also acts.
Recently, IPCA Labs acquired the promoter's stake in Unichem. How do you view this from a corporate governance standpoint?
So wouldn't have a corporate governance impact. In fact, in pharma industry, there are two ways to scale operations, and one of the cheaper ways sometimes is to buy a capacity which is already available and has all the regulatory approvals given to you. So acquiring and expanding that way can be actually beneficial in the longer run for shareholders of the acquiring company. I don't see a governance concern as such. It remains to be seen how the facility that they've acquired is compliant in the longer term. So a lot of these facilities which are exporting to the US, they always face these US FDA alerts. And that is a concern which most pharma companies have to deal with. So maybe that is the only governance risk I perceive. But otherwise, it should be okay to acquire and expand if it's available at a reasonable valuation.
You continue to remain invested in IEX despite the various policies under discussion. Can you please explain your rationale for the same, and how do you view the impact of these policies if implemented?
Sure. So, any business activity that a company is in, the regulators and the government would want some amount of competition in that activity. That is a given. So, for example, we have 2 stock exchanges, we have 2 depositories, there are more than 1 commodity exchanges in the country. However, what we have seen is that there is some element of a first mover advantage. So, these are network effect kind of businesses where people who already have a customer base then continue to have that customer base, and customers generally have reluctance in terms of shifting. Whether that will continue in this case or not remains to be seen. So this market coupling regulation that is being spoken about could in theory open up their order book to competition, and the order book depth may not have that much of a entry barrier or things like that. So that is the part on risk and what could go wrong with the company. Again, people talk about the tariff coming down. So whatever they are paid per unit of electricity, that could in theory come down. However, on the other side, the traded electricity in the overall generation and consumption of the country is at a very low level. What we have seen is over a period of time, as markets are deregulated, as more and more people come in, and especially with the addition of renewable energy to the overall energy mix, the importance of matching the producer and the consumer really takes off. The other thing that happens is that solar power is only available during daytime, and at night the prices of power shoot up because solar supply is not there. Now, could there be a possibility where there would be permission given to traders who have storage facility who could draw power from the grid during daytime and resupply the grid at night time and take advantage of the price difference, and over a period of time that price difference comes down. So there are plenty of possible positives that could come about for IEX. There are plenty of negatives that could come out. So both factors are there. We will see how things play out. Anyway, it's not a very big weightage stock in our overall portfolio. So we have not been adding to the company in recent times, and we'll see how things pan out.
Earlier this year, you exited Suzuki Motors and invested directly in Maruti Suzuki India. What was the rationale for the same?
Yeah, so as we have discussed, there is a limitation on remitting money outside. So we cannot buy foreign companies. Now, the weightage of Suzuki was coming down continuously, and we were not able to top up Suzuki. And at the same time, we were seeing revival in the auto demand in India in the four-wheeler space. So we thought the foreign limits are better utilized by selling Suzuki and shifting that money to the other stocks that we own, and we bought Maruti in India. Raj, you want to add in?
Yeah, nothing to add.
Very Charlie Munger-esque. What was the reason to sell Hero Motocorp? It seems that the stock has started to perform after you sold it. Do you think it was an error on your part?
Yeah, so these things will happen very, very frequently. So stock could go down after we purchase, stock could flatline after we purchase for a long time, stock could increase in price after we sell. So as long as we are following a particular method, or there is some method to our madness, that should be fine, and that will keep happening. So Hero, Honda in the earlier avatar and Hero Motocorp now has been a company which has generated decent shareholder returns for investors over the years and things like that. And they have also had a pretty strong market share in the two-wheeler space. And we were aware of some of the initiatives that they were undertaking. So all of that was in public domain. So their investments in Ather, for example, or their work in the EV space and things like that, their JV with Harley Davidson. So all these were expected to bear fruit sometime or the other. But at the same time, there were these allegations that were there, and which again were in the public domain, which added a huge element of risk. And again, in answer to the previous question on Suzuki and Maruti, I mentioned we were expecting a revival in the four-wheeler space. So given the overall environment and context, we said it's better to be invested in the four-wheeler space rather than be in Hero Motocorp. So yeah, even Maruti has been doing well of late.
There are fears of an impending US recession. What is the outlook of the IT industry given these circumstances?
So if you look at the history of US recessions or maybe drop in the growth rate in the US, so very recently was the global financial crisis. COVID was the most recent, but in the global financial crisis, then there was the dot-com bust, and in the mid-90s there was a financial sector crisis. So at every given point in time, the same kind of questions kept on being asked about the outsourcing companies as to what happens if the customers don't do well. That risk always remains. However, we need to also understand what the outsourcing companies do. One part of the answer I gave earlier to Neil's question on Infosys, the outsourcing companies help in managing the cost of technology adoption for all these companies. And adopting technology, it actually helps them maintain the cost of running that business over a long period of time. That trend is unlikely to change. There might be cyclical slower growth sometimes, which is fine, which most of these businesses have seen in the past. And if you go back long enough in the history of the listed companies, you will see that there were pockets of 3-4 years where the growth has slowed down. Again, the growth has stabilized. So we have to look at it as a normalized growth rate over the period of 5 to 8 years. That's a reasonable time frame to look at. So yeah, it's quite possible. There's a high chance that there might be a temporary recession or a cyclical recession. But these companies have seen worse times than this. So I don't see there's a concern from an IT services industry point of view.
The next question is that Persistent has continued to perform even after you sold it. Do you think that you sold too early, and what was your rationale to do the same?
Well, looking at just the price, yeah, it's obvious we might have sold too early. But you have to look at it on the context of why we sold some of the other holdings along with that. So Persistent, Infosys were some of the mid-cap or medium-sized IT services companies. And for the longest period of time, Persistent had actually dragging itself as compared to the industry average growth rates. And once the growth rate started coming in, the business started doing well, the stock price started performing, and the valuations shot up. So in the entire mid-cap IT space, the valuations had gone to a level, even today they are at a level which is much higher than their past 10-15 years median valuations in those companies. As a IT services business, maybe, yeah, the growth rate is very good and the company can do well, but there is a base rate to how fast any of the IT services companies can grow. So we wish all the best to all these companies doing well and growing fast, but at a certain valuation, it doesn't make sense to buy the same business if a better quality or larger business is available at a much reasonable valuation. So that's why we sold the mid-cap IT companies. But yeah, price can be debated.
When you invest in HDFC Bank, do you also get the benefit of HDFC AMC and HDFC Life Insurance? Is it better to invest in these companies directly?
We do get benefit because these are subsidiaries of the HDFC Bank now. If someone has a very strong view on the particular sectors, let's say asset management or life insurance, then they would get more bang for the buck if they bought the companies directly. However, what is to be realized is when we own the bank, we get to participate in the manufacturer's remuneration as well as the distribution remuneration. So, for example, in asset management, there's a management fee that the AMC gets, and there's a distributor commission which the AMC pays to people like banks. If you invest in the bank, not only do you participate in the distribution commission that the bank gets, you also participate in the AMC fee that is generated, given that it's a subsidiary. Same goes for life insurance and general insurance.
Next question is again one that Rajeev gets every year, and I think his answer changes slightly every year to it also. And Neil as well, actually. How is PPFAS managing the Keyman Risk for all FMs, but with special emphasis on Rajeev?
Yeah, so there is some suspicion within the organization that I engineer this question each year, and it helps in salary negotiations. So I'm glad that you asked this. Neil, please keep this in mind.
Yes. Yes, I feel like just like Rajeev gets questions on AUM, I get questions on Rajiv's departure. The only difference is he gets different questions each year. 2 years back it was ITC, last year it was FANGs, this year's AUM. But I get the same question every year. But yeah, jokes apart, I mean, look, I think people make an organization, you know, when you're starting up. And we were starting up about 10 years back and even much longer than that during PMS and all. You need good people. You need people that you can trust and vice versa, right? I mean, that makes the organization. Obviously, Rajiv's been here for more than 20 years, more than me, for sure. Ronak Raj have been here for more than 10 years. Again, 4 of us have been here since the inception of the mutual fund. Rukun's come in recently and he's already gelled in very well with us. So I think there are 2 things to it, you know. So one is what the company can do for you, right? I mean, so we've given ESOPs. All of them are owners of the company more than just the employees of the company, you know. So ESOPs are there. I think there's skin in the game there that, okay, you know, if the company does well, we do well. All of us do well together, you know. Obviously, we are also in a state today, or we are where we are today, we can give good salaries. I mean, again, market salaries, you know, I don't think that was a thing 5 or 7 years back, you know, so that was a bit of a struggle then. I think today we're in a much better wicket to compensate adequately, you know. Yeah, so all of these things are there. They've been here longer term, but I think the more important parts of it is like, are you happy doing what you are doing? Are you happy with working with the people you are working with? Do you have that relationship with those people? Do you value those relationships? Do you value the culture of the firm? Are you getting good work-life balance? Are you getting time to spend with Hema and Dhwani adequately? All of those things, I think, play a big role, you know, instead of just, say, monetary or anything like that. Also, the one thing is that, yeah, when you have people, good people, they create processes, you know. So the processes have been set. We have a very strong investment philosophy, as Rajeev mentioned, investment philosophy and a process. And as those processes get set, it's easier for people who've been there and newer people who join us to easily get into that, you know. I mean, if they really believe in what we're doing. So more and more people join us, and more and more people get integrated with us, you know. So yeah, I would think, I hope we all are here for decades to come. And yeah, we can continue this journey together, because I think we've grown, I think I can be very frank here, we've grown more than colleagues. I think we have a very deep relationship with each other. We're more like friends. We travel together, we eat together, we drink together, we do everything together most of the time. So yeah, our relationship is strong. I would think, at least, I mean, they can, Rajeev, Raj, Ronak, Rukun can answer that. But I think relationships are strong. I think relationships would I think help us go the next, hopefully, some decades. You guys want to add something?
So, yeah, and the important thing is, if you were to measure success, it would be whether the organization, whether the functions can go on in the same manner when different set of people are there. So, for example, Mr. Deepak Parikh is not running HDFC Limited anymore. Of course, the organization has also merged, and Mr. Aditya Puri is not there, but HDFC Bank continues. Mr. Uday Kotak is not there in Kotak Mahindra Bank, but the bank continues. So, essentially, whether an organization is good or not is partly determined by whether the organization continues beyond people, and hopefully we will have a situation where we have that continuity in PPFAS. One of the things, interestingly, I want to know is maybe next year we should keep this field that people who are asking about key person risk in PPFAS, how long have they been invested in the scheme? So people who invested 2 months back and who are going to redeem in 2 months ask about longevity of people who have been around for decades. That's the irony.
Next is, when is the PPFAS IPO coming, and do we as unit holders get an allotment?
So not now, not anytime soon. But look, we are a unlisted company right now. It's closely held by family, friends, employees. There's honestly we don't really have a need to raise money as of right now. So I would think at least for the next few years, we probably would not see an IPO, but we're not taking anything off the table. We do have discussions internally about plans, about like I spoke about, like whatever we do, we think, long term. So, okay, where do we see ourselves 5 years, 10 years from now? And at that point, there could be there could be a chance of probably a listing or something like that. But I don't see it anytime in the next 3-4 years at least, So we'll keep evaluating that part, and as and when it ever happens, people will know.
Unit holders, do we get an allotment or a discount?
Let's cross that bridge when we reach there.
Okay. The next question is on expense ratio. You obviously have to mandatorily reduce expense ratio as the scheme grows, but is there a trajectory you have in mind, or you'll go by the SEBI limits?
Yeah, I think over the last 10 years, we've actually cut the expense ratio voluntarily quite a few times, So, again, expense ratio have been cut. There is pressure on expense ratios for us as well as distributors. And I think it's fair right now. I don't think it's high at all for that matter. So, so voluntarily, I don't see ourselves cutting expense ratio. Obviously, as assets grow, we'll automatically have to reduce those 5 basis points every 5,000, 10,000 crores. So that will automatically happen. Automatically, the expense ratio will come down as assets grow. But I don't see ourselves voluntarily now cutting expense ratio. We've done that a few times in the past.
Yeah, I'll also add a little bit. There is a proposed regulation on expense ratios where expense ratios will be determined on as class basis rather than on scheme basis. And there is also a proposal to include things like SCT or maybe brokerages that are paid as part of the expense ratio, which are currently outside of that. Now, if that regulation comes in, optically maybe you will see the expense ratio increase a bit when that regulation comes in, not just for our fund house, across fund houses. So our portfolio churn rate is not that high, so we may not need to increase it so much to incorporate brokerage, but some people may optically need. So economically, nothing changes for the unit holders. It's just that the disclosure on the website or in the fact sheet will be a bit different as and when that comes. So right now we don't have a final circular or we don't have a final decision on that yet, but we'll see as and when that comes about.
And the next question for Neil again. NPS has various tax benefits and it has the potential to be as large as the 401k in the US. Given that some of these features are in line with your style of investing, would you consider being a fund manager in the NPS?
Yes, I think like you mentioned, in theory, it sounds great and it would probably be something in theory you would look at it and if things would work out, it's something, it's not bad. It's not a bad thing, right? So it's not, the only thing is that you need really large AUMs to run this. We have to set up a new company, a new vertical. So the same people will not be able to manage the NPS. There'll be a separate team we'll have to hire. Again, it'll be just a separate vertical where costs would be very high. Again, if you see recently, the expense ratios on those are like 3 bases, 4 bases kind of expense ratios they're working on. So again, you need, I think, lakhs of AUM to be at least break even or be profitable. Again, we've been here for 10 years and we've just hit 50,000 crores, right? So I don't know how much AUM we would get in that. And again, you don't see too many. Again, if you see whoever's launched NPS are the bigger guys, who have that staying power or the power to take losses for many, many years, So as of right now, I don't think we are in a position to launch an NPS. Again, it's something that as we reach scale and size, that could be something that can be looked at a later date. But right now, I don't think so.
And let me just add over there. So NPS, the biggest managers are the managers who got allotment of the government pension money, the government employees at the early stage. Now, for those people, it's a profitable activity because, as Neil mentioned, they have maybe lakhs of crores of assets under management. The newer players have had a very difficult path, and a lot of them are making losses even after many years of launching that activity. And the expense ratio is such that effectively you will be running a closet index fund because the expense ratio barely covers the operational costs and does not even leave enough money for a research budget or for a fund management and analyst team. And if someone wants to invest in the index fund anyway, low-cost index funds are available in the mutual fund space as well. And again, ETFs, we are at 3 bases and 4 bases. Ironically, the regulations now are such that it's very, very difficult for newer players to break in because I cannot cross-subsidize. All the scheme-related expenses have to be debited to the scheme itself. So let us say if PPFAS were to tomorrow launch a Nifty ETF with a 20 basis expense ratio, and at 20 basis we are not making profits, that's a break even. Who will invest with us when other people are there in the market at 3 and 4? So then it becomes a vicious circle. You start off with a high expense ratio, and because your expense ratio is higher, you will never scale. So that's the challenge. Both of these look attractive in theory, passive funds and NPS. But practically, I don't see a way for us to do something meaningful there, at least at this point in time.
The next question, I don't know if it's correct, but it has come in. Why have SIPs and investments from US and Canadian residents stopped suddenly?
Yeah, so we were accepting those investments till the recent, at least till 2 months back. And then we got, we took some legal opinion about this and we were trying to do something else and this came up. And so there are countries where you can't market your fund unless you take approval from their regulator. US and Canada come under those 2 countries. So we are accepting money if they are physically present in India, and that's fine. That we can take a proof that, okay, y'all were in India, you're on the Indian soil, and you've given us investment, and that's fine. But it's a very big gray area when you're doing it online. Even if you're capturing some their location or whatever, it's very hard to know where exactly the location is from, and it could be outside India. And we took legal opinion not only in India, but we also spoke to a US legal firm, and they also told us that this is a very gray area and it's something you should probably be on the side of caution. And that's again what we're doing. We'll try to get more information on this, but prima facie it seems that you cannot market your fund outside in these countries, and buying it online also is a form of marketing that they're buying in because you have solicited some business. So we don't want to get in trouble with the law. So
Right. So just to clarify, if the US or Canadian resident has given a physical check in your office in India or even an SIP mandate, that's fine.
that should be fine. Yeah.
Okay. Back to stocks. So Meta seems to be lacking some clarity in terms of direction of how they view the business evolving. So why do we continue to hold the stock?
Actually, I have the opposite opinion of that. They have been extremely clear as to how they want to run that business. We may agree or disagree on the direction that they have taken, but their primary purpose has been to be a digital advertising platform through their social media apps. And if you see the number of users year on year growing on all the social media apps that they run, that is quite astounding. It has never happened that such a large platform has been available, and all of us in the room will be users of either one of their apps on a daily basis. So that is one mandate, and on that mandate they have done very well. They have created a very good ad product where advertisers can easily onboard, and the long tail of advertisers, which are smaller brands, people who cannot have the budgets for doing big advertisements in the traditional media, that mandate they have executed very, very well over the past several years of their existence. The other area on capital allocation we can debate on whether the artificial reality or virtual reality, augmented reality piece is something that they should invest so heavily in. But if you see some of the other investments they have made, which is on the artificial intelligence side, AI side, those are actually playing out very well in their existing products as well as in the open source AI community, where their models are also equally revered as compared to some of the other models. So these investments don't come without taking that kind of directional risk that they have taken. At the same time, trying to be on the cutting edge of technology, saying that, okay, we also want to have some presence in that particular model, and that feeds into the existing business of showing advertisements to the audience who are using the apps. So I think they have been very, very strategic and clear. The only thing is investors will have to debate whether these investment decisions are good to do at this level of the business or not.
And Neil, let me just interrupt something which we should have done at the beginning. I'll just, so apart from people sitting on the stage, we have our colleagues from the research and investment team sitting in the front row. Maybe they could just stand up and wave out to the in-person audience and others. Abhishek, Mansi, Viral, Prithvi, Aishwarya, Radhesham, Yatin, and Rohil is here. Evita, yeah. Thank you.
The next question is on Motilal Oswal, which is continuously losing clients or revenue per client. In such a scenario, why do you remain invested in the company?
So in the brokerage space, there have been two trends which have been playing out. One trend has been the advent of discount brokers. So you have had Zerodha, Grow, Upstock, and many others who have come in that space and who have been offering a complete digital online transaction model at very, very minimal brokerage charges. The other segment, which is the, and this has been gaining overall market share. The other segment is the full service brokerage, where you have people whom you can phone and talk to before you place an order, or people who send you research reports and things like that. So the other space has been seeing a huge round of consolidation, where the smaller brokers have been becoming franchisees of the larger brokers and have been giving up their primary membership. So in this space, people like Motilal Oswal, among others, have been gaining in terms of mopping up some of these smaller operations, and so they have a good amount of profit share. So apart from the brokerage, both institutional and retail, they have the asset management space, they have the wealth management space, they have the alternative assets, so in the private equity and venture capital kind of things, and they have the housing finance company. We were buying this company some time back, so we have bought the company roughly half of where it is currently. So we haven't been buying in recent times, but broadly it has been doing reasonably okay in terms of the businesses that they are in.
Rajiv, people will start reading into this. You haven't bought Coke in the US, have you?
No, we haven't. Yeah, it's a probably hat tip to Berkshire Hathaway and Charlie Munger as well.
SEBI has released a paper on voluntary delisting of holding companies. What are your views on the same?
Firstly, it is voluntary. So just because it's there doesn't mean that all the holding companies will suddenly rush out and do something. In most companies, I don't expect anything to happen. But in a select few where the promoters have been wanting to distribute shares for whatever reason, either generational transfers or something like that, it would be one more enabling feature, and some companies would actually benefit as and when the guidelines are finalized.
Couple of questions on REITs. First, is there any merit in increasing allocation to REITs now, as both yields are more attractive and of course prices have come off? So it's the same thing.
Yeah. So we have some investments in REITs. Now these went up in price and then again came back to where we had bought them. So of course in the interim period we have earned from the payouts that the REITs made. The REITs we own in the conservative hybrid fund. So what I'm saying is in the context of that fund. Now, obviously the return we have made on REITs in conservative hybrid is the payout. There's no capital appreciation that we got. But in the past 18-24 month period, what has happened is while REIT yields are back to where they were maybe a year or two back, the yields on commercial papers, certificate of deposit, state development loans, those yields have moved up significantly. So I'm not so sure whether it's that much of an advantage buying REITs today. Of course, the other positive arguments are still there. So as and when the work from home winds up and people are back in office, as people sign up more and more office space, as rent escalations start coming in, as the vacancy rates go down, REITs should do well. But the only negative factor is overall interest rates have moved up. So that is weighing a bit on the REITs.
Just one tidbit to add from an MF investor's point of view. So when we directly hold REITs and InvITs and they distribute various cash flows to us, the taxation is a bit complicated, especially the return on capital bit. And that was made complicated by this budget, whereas where a mutual fund owns the REIT and the REIT gives out cash flows to the fund, again, just like dividends, those cash flows are not taxed. So that's a bit of an advantage to hold it through a MF. One more question on REITs. Is there any regulation at which these REITs buy underlying assets from their group companies?
Yeah, so just like related party transactions in companies, here also there are regulations on related party transactions. So they have to take approvals from unit holders. They cannot unilaterally do things. They have to get proper valuation reports from multiple agencies, submitted to the board or the decision makers, and then go through the whole process. So it's well regulated in that sense.
What was the rationale behind exiting Sun Pharma? Their investments in the specialty business are starting to pay off now.
So again, to repeat, the pharma investments that we do, they happen at a point in time when the company is undergoing some current news which is unfavorable for a short period of time, like an FDA alert or some business not doing well. In Sun Pharma's case, all those things were true, and they executed very well. So even despite of that, the domestic business continued to keep growing. The export business, whatever was not under FDA warning or import alert, they continued to execute well on that. And product portfolio also was very diversified. Over a period of time, the valuation was inching into a territory where it was not very comfortable to own, and we found better opportunities to deploy that money. So we exited. And the specialty portfolio will do well because there will be a lot of things that they've invested in the past which will play out in the future. However, the percentage of profits coming from that is still a small percentage, and the bulk of the business is still the traditional generic export business that they run.
Why do you continue to have no exposure to cement and paint industries despite having 15% cash levels?
We track these sectors, so as and when something looks attractive to us, we will invest in those. Paints especially, I have been trading at very, very elevated valuation levels for a while now. Cement, off and on, we have come close to investing in a company. We used to own Ramco for a brief period of time, but currently we don't have conviction in any particular company at the current valuation. We track them, and as and when something looks attractive, we will buy in the scheme.
A similar question for chemicals, which have seen a good correction in recent times. How do you evaluate this sector?
So correction is in valuation terms and also some business terms, where companies who had expanded capacity in areas where Chinese capacity was temporarily off. Now China also has been starting to export at the same rate or even at a larger rate. Production volumes have also gone up. So that's the challenge with chemical space, where we have to also understand the cycle of that commodity which they're investing in, and also the impact of that one commodity on the overall profit of the business that we're considering. So if one single commodity is giving up 50% of profits for any business, it becomes very hard to then build a confidence that what if that cycle turns bad and you're getting stuck in the wrong end of the cycle. So anyway, cyclical businesses, we are not very good at finding them and tracking them and owning them, but we study them only because there are certain aspects which are specialty in nature, which are scaling up in India, and the China plus one narrative continues to drive some of these businesses. And the valuations, of course, despite the fall, they have not been very, very attractive. So yeah, if they come in a very attractive range where they are closer to replacement cost of the same assets, because it's not very easy to build a new chemical business in India anymore, as it was, say, 15 years back. So we keep monitoring them, but nothing has come in the radar which was very attractive.
Next question for you again, Ronak. Given the AI boom, would you prefer to hold companies that have higher exposure to this trend, such as NVIDIA?
So if you look at the AI boom, we already are exposed to the companies who participate very actively in the AI boom. It can be either on the infrastructure side, providing the cloud computing capacity for AI companies, or having their own models out there, or directly partnering or owning minority share in AI companies out there. I think it is a better way to do it this way. It diversifies the risk, and we don't take the venture capital bet, like Rajeev was saying, to invest in some of the AI companies. Again, NVIDIA is not a venture capital company. It has done phenomenally well, and I think it's a outlier in terms of how they executed in this space, where the AI hardware itself was not available, but they created something which is very specific for the AI industry to grow. So a lot of forces came together to make NVIDIA the kind of business that they run today, and the kind of profits and volumes they see today in the AI space. I think kudos to them, but maybe we missed it at a point in time when it was not very obvious that they were doing that. But on the other hand, we participated in some other way by owning the cloud infrastructure or platform players, or even the players who created models now, which we see. We already own them in the portfolio. So we haven't missed the AI bus, so to speak.
Ronak, still for you, what are the challenges of investing in the health insurance industry as well as hospitals?
So hospitals, I'll answer. Insurance, maybe Rajeev can take. If you see hospitals, a single hospital which has done very well over a long period of time can be considered, because the asset gets depreciated, the return on capital over a period of time shows well. But if you build a group of hospitals, that record of having a long history of return on capital has not been there, at least in India. So it's not a very attractive space to invest in. We keep tracking it as part of the healthcare coverage, but doesn't stand out compared to other opportunities in healthcare, like say diagnostics or pharma or other opportunities. So yeah, it's something we track, but nothing stands out immediately in terms of growth prospects or valuations that are there in the space. Rajeev, health insurance.
Specifically, among the various businesses that general insurance companies run, health insurance may not be the most profitable or most attractive opportunity. So I would rather look at investing in a broadly diversified company. Of course, now we have listings of pure health insurance companies, and some people are excited about that. Our stance has been that wherever more diversified business has been available, we have tended to invest in those spaces. So again, for example, people used to ask us about gold loan companies. And at that time, we said that it's getting exposure to just a monoline business. And theoretically, banks could also be participants in that business. And in the last 1 or 2 years, we have seen that actually play out, where banks have become aggressive in the gold loan space. So rather than being exposed to only one sector, and let's say something like COVID happens, if you are only in the healthcare space and for some reason the claims are elevated, then the risk is to that extent larger. We have presence in the insurance space indirectly via the Bajaj Group companies. By holding banks, we also own their general insurance companies, and we are happy with that. Not looking to increase direct participation in some of these downstream businesses.
So one more point I would like to add, I think Rajeev in a couple of years back had mentioned that some businesses are considered as public goods. They are not businesses which are designed for earning profits for shareholders. Hospitals is a category of businesses where actually public good is more important than the equity shareholders' profitability over a long period of time. So that is a different incentive for owning such a business. It's very hard for a hospital to keep generating dividends or keep paying out money and keep running the business at a way where profits keep going up and patients over a long period of time struggle to pay or afford those services. And if you see the ecosystem of hospitals, there is a lot of opportunity to study that. We can look at medical devices, diagnostics, and other supply chain of the hospital business, the medical industry, or even AI for that matter, is actually a very interesting space to look at. And how hospitals benefit and improve patient care is far better to study than to buy a hospital, in my view.
Yeah, again, expanding on what Ronak is saying, even when it comes to health insurance, government is coming out with these schemes where for a nominal amount, people can get some basic coverage on health insurance. And it's not that these will be very, very profitable activities for the people providing them. So in India, many of the things that in the West are seen as for-profit activities, we tend to convert them to public goods. The payment ecosystem, for example, UPI, people can transfer money peer-to-peer or peer-to-merchant free of cost, and merchant also does not have to pay anything. If you pay 100 rupees, the merchant will get 100 rupees. If you were to do that same transaction through a credit card, maybe a 2% fee would go to the credit card, to the banks and the card companies. Where debit card, it may be something like a 1% or somewhere thereabout. So what was a for-profit business model in the West, in India it runs as a public good. So some of these sectors, health insurance and hospitals and all, that risk anyway remains.
Are the members of your fund fully invested in PPFAS schemes only, or do they invest in other funds also?
So it's a interesting question, and one of the pain points for us. Increasingly, for liquid funds and for arbitrage funds, we don't invest in our own schemes. We invest outside our fund house. Now, liquid funds and arbitrage funds are designed for quick investment, quick redemption. When we invest in our own schemes, firstly, there's a minimum 30-day Contra investment rule where if you have bought something, you can't sell for 30 days. And again, each time you buy, each time you sell, you have to prove that you don't have any inside information and there's not going to be anything which is going wrong with the scheme and all that. So at least for these short-term investments, we invest outside of PPFAS funds. Anything else to add? At least speaking for myself, my long-term equity investments are all here.
Same for me also.
Yeah, same for me. I've got some liquid investments outside PPFAS, but anything more than a 3-month horizon is in PPF.
In fact, at the corporate level also, we are now investing in outside liquid funds and things like that.
Yeah, same for me as well. Liquid arbitrage. So, quick plug here. In Mint, we have a series called Guru Portfolio where we've chronicled some of their personal investments. We don't go to fund level, but their asset allocation, etc., you can see there. What is the difference between a Flexi Cap fund and a Contra fund? And would you say that the Flexi Cap fund is a Contra fund indirectly?
So we don't become contrarians for being contrarians. It's not contra for contra's sake. Many a times we are consensus with the market if it makes sense. Many a times we take decisions which seem unpopular or which go against prevailing market wisdom. So I would say that we are first principles based fund. So we do our own thinking. We don't outsource our thinking, and we take actions which look logical to us. It's not necessarily contrarian.
Now, you dwelt a lot on the size set of questions, but this is a somewhat nuanced one. With increasing AUM, we see a large cap bias in the fund, whereas the objective with which the fund was launched was Flexi Cap. So how do you address this?
So we have the benchmark for us is Nifty 500, and there are 500 companies in that index. The top 100 companies are referred to as large caps. The next 150 companies are referred to as mid caps, and the final 250 companies are referred to as small caps. If we were to add the corporate profits of all these companies, 75% of the total profit pool is in the large cap companies, which is the top 100 companies. The bottom 250 companies would account for 7 to 9% roughly of the overall profit pool. And the remaining would be in the mid cap space. So again, to give a food analogy, maybe I'm hungry, so I'm giving a lot of food analogies. So in a thali kind of situation, mid cap and small cap are like your achar and chutney. You can't make that as a main course. They are not as profitable companies as the larger companies. So in a balanced portfolio, so what happens in the small and mid cap space is that when markets are rising, the mid cap stocks rise faster than large cap stocks, and small cap stocks will rise faster than mid cap stocks. Again, when market is falling, mid caps will fall faster than large caps, and small caps fall even faster. This has been seen in the past cycles, may not necessarily repeat in the future. We spoke about Persistent and Infosys. When the time was right to increase exposure in small and mid caps, we were buying those companies when mid cap IT was available at a discount to large cap IT in a very meaningful way. We were increasing exposure there. When tables turned, when large cap IT became far cheaper than mid cap IT, we shifted bias. We moved out of small and mid caps and we shifted to large caps. So when the opportunity next comes where mid and small caps are looking very, very attractive, we will buy in that space. The number of stocks could be a bit higher than last time round, given the somewhat higher AUM. That's the only difference that will be there.
Neil will take last 5 minutes for moderated questions, and then we can take live questions.
Sure. The next question is one you get frequently, but it comes from a strong stream of thought that should fund managers take cash calls or not? So the question is, why do you maintain such high cash levels in the fund? Will it not lead to cash drags if the market rallies? Is it not assumed that the equity investor has already allocated money to another fund or asset class for their liquidity needs?
Okay, so in the marketplace, there are these things called balanced advantage funds. which actually do this, where they take cash calls and things like that. I, in the presentation, gave the past rolling returns on Nifty, which are around 12% per annum. Today, keeping cash doesn't mean currency notes. Cash is money that is there in the bank account, which we deploy in money markets every day. This generates, in the current environment, somewhere around 6.5–7%. Now, assume that the cash is giving us 7% and equity is going to generate 12%. We have a drag of 5% per year by keeping cash. However, the equity market does not give you that 12% in a linear fashion. Sometimes it will go up 20%, someday it will fall 25%, again go up 30%. It keeps yo-yoing, and individual stocks fluctuate more than the overall market. So having stocks in our portfolio and having cash allows us, if for no rhyme or reason some stock goes up significantly, we have an opportunity to sell the stock. Again, if something we are tracking, if that falls in a meaningful way, having some cash allows us to avail of that opportunity and buy. So when the conservative hybrid fund, for example, we owned a stock called IRFC. Now, we owned the stock for it being cheap and high dividend yield and a cash flow stock. Now, suddenly in a span of few months, the stock tripled. And in fact, our internal house view was that this year they may not grow much, given that they may not need to resolve too much market borrowing. But if the stock triples, we can sell that. And if something falls, like Neil referred to the COVID crash, that allowed us to build positions in the stocks that we like. So, sure, some of the times it may look like a drag, but I would think it benefits us more than it harms us.
I'll take one last moderated question, after which we open to audience questions. So please be prepared. In case there are still some time left, we can go back to the remaining moderated questions. So the last question is, why is international diversification restricted to companies in the US and not other geographies?
Sure. So although the country of listing is the US, the business that these companies derive from, that these companies have, is global in nature. So a Microsoft does not sell Windows operating system and the office productivity tools only to US clients. It sells in Europe, it sells in Asia, Africa, South America, all over the world. Same with Google, Facebook and Amazon. So what we have said is, when we are looking at international diversification, we want global multinationals and which are easy to track and which are adding value to the overall portfolio. So in the past, we have had Nestle, which is technically a Swiss company, but derives just 2 to 3% of its revenue from Switzerland. And it's a global multinational. So we don't so much look at country of listing, but we rather look at their overall business.
Do we take a break or directly head into audience?
We can get into audience question and answer. There's a mic at the front, so people and at the back also. So whichever one is nearest to you, you can queue up and we'll take turns. Just give us a minute for my colleagues to be there and they can manage the queue orderly. Yeah, we'll keep rotating between the 3 mics that are there, starting from one and then we'll go to the other ones. Yes, please.
Yeah. Yeah, hi, good evening. First of all, I would like to thank Neil, Rajeev sir and the entire PPFAS team for organizing this event and sharing your knowledge with us over the years. This is my first time attending the meet in person, and I look forward to attending many of these in the future. So I have 2 questions for Rajeev sir. and I'll be grateful if the other fund managers could add to his answers as well. So the first question is, in the past, you have reiterated time and again that the first thing you look out for while valuing a company is the quality of the management. But what if, due to some negative developments regarding the management, the company is trading at a deep discount to its intrinsic value? Would you be willing to look into it as a favorable investment opportunity? Or is it the case that the value attributable to the management, which was earlier reflected in the intrinsic value of the company, is lost forever? And the second question is, can you share some of the valuation methods and metrics that you use to value businesses? Also, you've mentioned in the past that a DCF is akin to looking through a telescope. A minor change and you're looking at something totally different. So would you tell us some, also, if you're using a DCF, how much credence do you put in the weighted average cost of capital, as it takes into account the volatility as a measure of risk in calculating the cost of equity? And if you don't use WACC, what is an appropriate discount rate you would use?
Sure.
Lastly, I know you are a voracious...
My memory is not so good, so I'll forget what you said at the beginning. So let me answer the ones you have already asked.
Sure.
Thank you. On management quality, so typically when you buy stocks, you want to buy it at a discount to the intrinsic value. And let us say your estimate of intrinsic value is 100 and stock is quoting at 60, then you will buy the stock at 60 and your expectation is that the price will move up to, let's say, 100 over a period of time.
Yeah.
Good managements will make the intrinsic value which you estimate at 100, that they will make that 100 to 125, 150, and you will have a pleasant experience investing with those managers. Bad managements, that 100 will go down to 80, will go down to 60, and will go down to 50. It will go below your purchase price. So sometimes it seems like a smart idea to ignore the management when the price is very, very cheap. But usually the experience does not turn out to be that great. So that's more or less our thinking. Valuation methods, how to value. Theoretically, the only correct method to value is discounted cash flow. However, it is subject to a lot of practical challenges where minor change in assumption can result in very, very wide range of values. So people who are deeply interested in this topic, I would request you to search for Professor Sanjay Bakshi's talk on this subject. He has used the movie Vantage Point and taken the plot of that movie in terms of valuing different companies. So he's taken the viewpoints of various people, like investment banker, like a corporate bank lender, and a strategic investor and things like that. So that's a excellent talk and a blog post for people to refer to. Weighted average cost of capital. So bond yields keep going up and down, and we don't do weighted average cost of capital kind of things. See, largely you start with some target return in mind. Let us say if, your target return is in theory 15%. Now that 15% can come out of earnings growth. It can come out of multiple going up or down, valuation multiple going up or down, or it can come from dividend yield in your holding period. So a combination of these three will be your holding period return. Now, in some cases, in the slow growth company, bulk of the returns will come by maybe dividend yields and maybe a 5% volume and earnings growth. In some cases, these are fast-growing companies, maybe growing at 15%. And if they are at reasonable valuation, your entry and exit multiple would be more or less the same. And you would end up getting the returns which were the earnings growth of the company. So it could come from various sources. So essentially, you have to use this vantage point framework to cross-check your answers from other models that you use, so that you don't fall prey to errors of assumption or things like that. Thanks.
Yeah. Lastly, I just wanted to recommend a book to you, which is written by Mr. Pulak Prasad.
Yeah, I'm sure I'm midway through that. Thank you.
Yeah. Thank you. Thank you so much.
Hi everyone, can we, as we got a lot of questions, can we just restrict to one question and keep it short, please, so everyone gets a chance? Thank you.
Yeah. Thanks everybody. First of all, thank you to entire Parikh Mutual Fund for managing our fund so effectively. My question to you, Rajeev sir, regarding, since you mentioned about the philosophy and the thought process which you referring to, more or less it's a value investing which you're referring to. My question is, there's a lot of buzz on the social media about the momentum investing. Rather, I would call it a momentum trading, because your entry exits are defined by the technical parameters. So I just want to understand your thought process or your view on the momentum investing.
Sure. So initially, academics went through. Initially, academics said that there's no way you can outperform, meaning if you are generating returns better than the market, then it's either luck or you are taking a larger risk. Then they said, okay, there are two other factors which result in outperformance. They said there is size and momentum. So the first answer, they said, if you are getting better returns, it's more risk. So they had beta as a factor. Then they said size and value are also correlated with returns. So they said maybe those two are there. And then finally, evidence was quite strong that the past stock price performance of a company over, let's say, 6 months or 12 months, that had some predictive value and that could give you slightly better returns. The interesting part is that these signals of the past 6 to 12 month stock price return last for a relatively short period of time. So they last for 1 or 2 months or 3 months. So, and it requires frequent rebalancing. So this may be suitable for people who are managing their own investments or who are managing small pools of money, and they are prepared to have this high churn strategy and pay the associated taxes and transaction costs. So it may be suitable for them, but institutions stampeding in and out of stocks every month or every 15 days, that creates its own challenges in terms of impact cost. Their own buying and selling will take away the potential returns. So the large institutions who are managing momentum related strategies, the track record has not been that outstanding in that sense. So yeah, again, our investing approach is fundamentals driven. So growth is a component of the intrinsic value calculations that we do, and then we try and invest at things which are available at an attractive price. Thanks.
Thank you.
Hi, sir. Thank you so much for such an informative session. My question is on real estate. You haven't been a big fan of real estate investment, especially luxury side. So can you share reasons?
Any specific company that you refer to? I neither own a very luxurious house nor I have luxury real estate company. We have some REITs in the conservative hybrid fund, which are office blocks and which pay a periodic returns every quarter.
I was specifically asking about Macrotech or Prestige or Shobha.
We don't own those companies, sir.
Yeah, so the reason.
Why not? Okay.
Why not?
Okay. Sorry, I misunderstood. So let's say if you are buying a soap company, the company will buy raw materials, let's say palm oil and a few others, and quickly manufacture the soap, distribute it and sell it out. Now, asset turns are very, very high and they can earn decent returns. In real estate, they would buy the land and they would have expectation that we will complete this project in 4 years or 5 years and we will make this much profit and this will be the return to shareholders. Invariably, what happens is the time to completion is longer than the estimate at the beginning. And the companies that are there, which are listed, the return on equity numbers have not been that good for those companies. So, on a project to project basis, people get excited that, and again, let's say there is a Mumbai developer who's done very, very well in the western suburbs. Now, that same developer is stuck with a high cost project in central Mumbai. Now, if you buy it looking at the performance in western suburbs, shortly after that, they will get stuck in some other project. So, it's not like a FMCG company or an auto company that you keep manufacturing and selling and it's a predictable thing. They live project to project and many times it becomes very, very lumpy, and track record in the past has not been that great. Thanks.
Hi.
Hi.
Hi, sir. Good evening.
Good evening. First, thanks for organizing this meet. It's really helpful. My question is, if we need to invest a bit of a sizable investment, is it good to do a lump sum or do it in like an SIP, but a short SIP, like 8 to 10 weeks or so? And I've read a bit on through books and other things, but I really want your perspective and what your experience has been in this. Thank you.
Sure. So for most people, SIP is preferable because they have monthly cash flows. So whether you are a salaried person or you have a profession which you run, a lawyer, a doctor or something, or whether you have a business, you'll have periodic savings, and those you should put in the asset class of your choice and do it in a systematic manner. So that works well. The question of lump sum arises when you get into sudden money. Let us say you get a big inheritance or you sell some business and you are in possession of a big asset and things like that. Now here, whether I'll answer this in two parts. One is pure finance and second is behavioral aspects of it. Pure finance answer, will lump sum be better or SIP will depend on the market movement after that. If the market keeps rising after you do your first SIP, then lump sum will be better because you would have bought at a cheaper price. If market is sideways or downwards, then a SIP will be better. So this is as far as the financial part goes. Behaviorally, putting it in small parts is always more comfortable psychologically. So you don't stress about whether market correction will come or not. Otherwise, we'll always worry, okay, on Sunday, state election results are going to come. So should I put the lump sum on Friday or should I put the lump sum on Monday? If you do it systematically, then that question gets taken away. So behaviorally, systematic is better. Otherwise, it essentially is a coin flip because you don't know how the market will behave over the next 6 to 8 months.
Thank you.
Thanks.
Thank you, PPFAS team, for organizing this. I had one question.
On one hand, you said do not worry about our AUM growth, and on the other hand, you want us to moderate the expectations on return. What should we give more weightage to?
Moderating of returns, I've been saying from the time we were 300 crores. So that is not something new that I'm saying. That is one. Secondly, if the market is going to give you an X amount, let's say if Nifty has generated 12% rolling returns, if you start with very, very high, so again, it's not necessary future will even give you 12%. US has had a decade where market gave zero. So 2000 to 2010 markets did nothing. Japan has had a very long period where returns were not there. Again, today, if banks are paying you 7% or 8%, a 12% is 50% more returns as compared to banks. Now, there's no law of physics or law of the nature that equity should give you 15% or 20% or 30% just because you desire such returns. So, again, Charlie Munger's secret to happiness is have low expectations.
Thank you.
Yeah. Hi, sir. Good evening. I would like to ask about your views on inflation and resulting risk of interest rate hike by Central Bank of India as well as US. Do you see we can again see a cycle of interest rate hike if inflation breaks out or recession hits?
Yeah, so I'll answer this in two parts. One is generally about interest rates and inflation, and then specifically about investing. So in the last 2 years, we have reversed out a cycle which was playing for a very, very long time, which was interest rates tended to go down all the time. So we had a scenario where European long-term bond rates were at negative yields. US long-term government bonds were close to zero. So now that has definitely changed, and I don't think the equity markets or overall asset valuations have taken into account this significant increase in interest rates. So to that extent, one has to be cautious in terms of what valuation one gives to the companies that we are buying. That was the general thing. Specifically in terms of buying equities, the companies that you buy, if they have a decent amount of pricing power, and if you are not overpaying for those companies, then they should broadly do well even in an inflationary environment.
Sir, my question was also regarding the conservative debt fund where we invest in debt securities because the impact of this cycle on these funds.
Yeah, so here we have a combination of short-term investments, medium-term investments, equities and REITs. Now, if inflation goes up, you could expect maybe rental yields to go up. And so we have some amount of diversification within the investments that we do in the conservative hybrid fund. But otherwise, whatever risk is there in a debt fund linked to inflation or interest rates, that same risk would be there in conservative hybrid fund as well. You cannot completely eliminate that.
Sir, first of all, thank you so much for having such an insightful lecture, and thanks to the entire PPFAS team. Sir, my question is, so Munger is known to have famously convinced Buffett that it's better to buy a wonderful business at a fair price than to buy a okay business at a bargain price. Sir, my question to you is, we have investments in Bajaj Holdings. We know that Bajaj Finance or Bajaj Finserv are quite better businesses. Why are we sort of diluting and not directly purchasing them?
So there's no dilution. In fact, there is concentration, if I may say that. If I'm buying a holding company which is quoting at a market cap of 100 and it is owning 200 shares worth of the subsidiary company, am I diluting or am I concentrating? For the same 100 rupees, I get 200 rupee worth of Finserv and Auto and the underlying companies.
Sir, wouldn't it be that unless the company is liquidated, we will not realize that. It's only when we see share price compounding, the compounding that of Bajaj Finance or Bajaj Finserv has been phenomenally greater than that of Bajaj Holdings.
So let us say discount rate continues to be 50%, right? Let us say the subsidiaries are quoted at 200 rupees and the holding company is at 100 rupees. If the underlying company doubles, let us say goes from 200 to 400 and discount remains at 50%, what will happen to holding company? It will go from 100 to 200, right? So this question was already asked and answered. So Neil asked me this question around holding companies, around Maharashtra Scooters and Bajaj Auto. The discounts have been narrowing in India and have not been increasing. I'll point you out to two European companies. There is a company called Heineken, which is the beer company, and there is a company called Heineken Holdings. I haven't checked the prices recently, but these used to trade at roughly 5% discount. It's only in India that you have these very, very large discounts. And okay, well, let me talk about a company that we do not own. Bajaj Holding is something called a core investment company, CIC. You can look up the regulations of CIC online. These are RBI regulations. They will only invest in their group companies. It's a holding company. Just look up Geo Financial Services and their application to convert to a CIC. Geo Financial will not be doing any business on its own. It will be holding shares of subsidiary companies which will do all these businesses. And the holding company publishes consolidated financials. So why should they not participate in the growth of the underlying?
So
thanks. Sir, I have said what we cannot get into a debate around this. This question was already asked and answered. You have asked a question the second time, I have answered that. We can take it offline. Beyond a point, we cannot labor the same point. This question has been asked for 10 years, sir. And for 10 years, I have been answering that. The returns we have generated from Maharashtra Scooters have beaten the returns on some of these other companies. Thanks.
First of all, thank you so much for doing such a fantastic job managing our money. For me personally, it's the thought process, the philosophy that keeps me with PPFAS. My question is regarding the power infrastructure. You did mention some piece of it in regard to Powergrid, but obviously there are so many other sectors within that: cables, transmissions, equipment such as transformers, and right down to the power meters and so on. So what are your thoughts in terms of, for all those sectors, the competitive intensity, the profit pools, and I'm sure you would have evaluated, many companies within that. So is it, obviously the valuations have gone up too much. Is it the valuations, or do you see some inherent, problems or lack of, attractiveness in some of the other sectors within the whole power grid?
Sure. So there are various segments in the power ecosystem. Whenever you are evaluating something, the question to ask is, what is the sustainable advantage that we have in this particular company or in this particular segment? So things like solar equipment manufacturing. Now, it's a complete price game. So if quality of some 3 different modules is the same, which one you will buy will depend on the price of the module. So then if plus you compete against imports and things like that. So in spaces where there is too much competition, it's better to be away from those spaces. Generally large projects, so earlier you had these ultra mega power plant kind of projects and those things like that. So those are utility kind of projects where typically either you get a fixed rate, and increasingly these days you have tariff based bidding where the returns are somewhat better than the debt returns, but they, for equity investor will generally be disappointed investing in those companies unless you get these shares at a very, very discounted price in a crash or something like that. So again, power generators generally have lower returns and lower attractiveness. Then we have spoken at length about the grid business, Powergrid and those kind of things. Then you have the distribution companies where there is some regulation on the amount of profits that they can make. Plus, increasingly, there is this attempt for deregulation and for bringing in competition. So, over there again, returns will not be very, very high. But if you get these companies at a discounted price in a crash or something like that, these could be decent businesses to own. And the generating companies, so people who were in the making these turbines and all, they have had a tough time given that most of the capital expenditure has been in the renewable space rather than in the thermal space. So companies like BHEL and all have had a tough time in the past.
Sorry, my question was more towards all the other, like the cables, transformers, equipment manufacturers and all.
Sure. So, volume growth will definitely be there, given the projects that are there. Plus, what we are seeing is shift of automotive transportation demand from fossil fuels to electric. As more and more two-wheelers and cars come into that space, you will require cables, you will require transformers and people who do switch gears and things like that. And over there, some of the companies have had very decent ROC, ROE ratios. We track those. We don't own too many of them in the portfolio, but our colleague has done a 1-hour talk on some of these businesses, and it's there on our YouTube channel. You could look that up. So yeah, there could be interesting opportunities in that space.
Thank you.
Thanks.
Yeah. Good evening, sir. First of all, thanks for the insightful session. My question is related to PSU segment in PSU share in your portfolio. So like banks, private banks are there, but PSUs are not there. I could not find much there. So first question is that why don't you see much share in that space? Because recently what we have heard is that larger private sectors are they have pressure on their NIM and all, and of course these PSU segment banks are doing well. So my question is, why not that much share in your portfolio? That's the first part. Second part, no exposure towards vehicle financing companies. So share in those companies. So that's my question. Thanks.
So in PSUs, there are maybe 1 or 2 or 3 banks which are not losing market share, which have improved their technology backbone and which have improved their product range. So a vivid example is something like a SBI, where they have the full product range, they have subsidiaries in various aspects of financial services, and that is a bank which we track, and meaning maybe it could merit investment at some point in time. But otherwise, the mid-sized and smaller PSU banks, the issue has been that they've been ceding market share over a period of time, and they periodically the balance sheet may look good, but they get into some credit quality issues or some trouble, and again the whole cycle turns. Or see, today when a customer is developing a banking relationship, that person is looking for a whole host of services. So that person will want a debit and credit card. That person will probably want a stock brokerage account, 3-in-1 account as it's called, brokerage, bank plus demat. It is beneficial to the bank if that person can be sold mutual funds, general insurance, life insurance, all of that. So a lot of, and the app has to be top notch. So you cannot have a third-rate net banking app and hope to grow. So a lot of these mid and small PSU banks have been facing challenges in some of these areas, and they have been ceding market share. So that's why we have not been big investors in that space. Vehicle financing. So see, today even banks can do vehicle financing. Yeah. Now, sure, there are some niche areas where NBFCs do reasonably okay, which could be second-hand truck financing, for example, or lending to the unbanked. But the cost advantages that banks have in terms of access to low-cost deposits and current account, saving account balances, that cannot be replicated by NBFCs. So our preference is to stick with banks rather than go to niche businesses.
Thanks. Thanks.
Hello, my name is Charvak Naik, and first of all, I would like to thank all the PPFAS team for providing such wonderful investor education. My question is regarding market psychology. So, since the COVID pandemic, I think the number of demat accounts in the country has gone up by 3 times, from 4 crore in 2019 to 23 crore in 2023. A lot of this inflow has been in the small and mid-cap funds, and we have also seen the subsequent run-up in the small and mid-cap stocks. And some of these valuations in some sectors, as well as in general small-cap space, appear to be quite high. So, most of you have lived through the 2008 financial crisis. Rajiv, you have also seen the tech bubble burst. So what is your experience about how sticky will these mutual fund flows be? Because these new investors have never seen a market downturn, a market crash. So what would you think their response be if there is some panic or macro risk or anything like interest rate panic? And I'm asking this question because I have a very small portfolio of my own, but since past 1.5 years, I am not able to find anything which is cheap enough to hit me in the head, and it also lies within my circle of competence. So I don't have any general views about the market, but certain sectors do appear to be egregiously valued, where average stocks are trading at a P of 70, 80, or even in some cases 100 PE. So what would happen? Because you have lived through crisis, because for any discerning investor, it will be a best opportunity.
Yeah. Investors which have come in last 8-10 years or so have learned just one thing, which is buy the dip. And it has turned out to be very, very profitable. So any event which people took the courage and went out and bought within a period of 24 months or 36 months, that turned profitable, including to some extent even the global financial crisis. If someone bought in 2008 or 2009, they did very, very well. What we have seen is that in short dips, we see a lot of inflows in the marketplace. An entire generation of investors has not seen a prolonged bear market and has not seen debt interest rates, especially in the developed world, of 4-5% on sovereign. So they haven't seen those kind of rates. So what will be the behavior in a prolonged bear market? I have no answer to that. It's as much your guesswork as mine. For short dips, people rush in. It's buy the dip. Thanks.
Thank you so much.
Hi. Thank you for taking my question. My name is Hussein Kagzi. So I just had one question, probably broken down into 2 parts. So I read somewhere, and I could relate to that there's a thin line between strong conviction in an idea or an investment and getting married to that idea or an investment. I mean, only sometimes in hindsight we can say which one is what. So what is your take on that? Have you yourself or even the team, you guys have felt that, and how would you navigate around that? And when there's an investment, where you have high conviction, but it is not yielding a result, it's there only. So when would you decide to bite the bullet on that, or will you at all? And just to continue with that, on this line only,
most of the fund managers and you guys are, people with similar mindset who get along on many of these things. So how do you as a team ensure difference in viewpoint, and ideas, and avoid thinking on the same line and try to incorporate a contrarian view? Thank you.
Sure. So one thing that helps us is any stock that is not doing well, Neil grills us on behalf of all the unit holders, and a lot of people do it in person as well. So nothing goes unnoticed. So even if we are married to the stock, unit holders keep us on our toes. So no worries on that. About groupthink, so on fundamental values, we want groupthink. So if we say that management quality is important, we don't want someone in the team to say, no, management quality is not important. We should buy shares in companies which are run by crooks. So for fundamental values, we want people to have similar thinking. Now, there could be debates whether person X is a good manager or not. That people can have different viewpoints, and that is encouraged within the team, and we debate and discuss those kind of things. But if someone says, oh, we should buy leveraged companies which are about to go bankrupt, then we don't want such people in the investment team. Thanks.
Hi guys, thank you. My name is Hussein as well. I want to start by saying that I'm disappointed because last year, Mr. Rajeev, your presentation started with a meme, and I was very much looking forward to some more memes this year. I hope to see some more next year. With that, I have...
Memes are banned now, so you won't see them.
Oh, no.
Memes could be taken as surrogate advertising, so memes are not permissible anymore.
Okay. So
one of the slides that I presented on could have been a meme. This is a quiz for people who watched. Just guess it and keep the answer to yourself.
Okay, thank you. So 2 brief questions. The first is about the upside capture and the downside capture, which you spoke about. So my layman understanding is that if we are investing only when things are significantly below intrinsic value, shouldn't the upside capture be higher than market or peers? Because we are holding on to cash, etc. So that's the first question. And the second question was about margin of safety. Typically, what is your margin of safety? If you assess that intrinsic value is 100, at what price would you all be comfortable purchasing?
Sure. So upside ratio, what happens is that in a strong up move, what we see is the frothiest stocks move the fastest. And in a down move, those go down the fastest. So in a up move, we tend to lag, and we more than make up, or at least in the past, we have been able to more than make up on the downside. So on an average, it does better. But yeah, you look at fundamental based investors in late 90s, for example, .com boom. Were they doing better than the market, or were they doing worse? So again, in 2021, there was one lady who ran a popular tech fund in the US, and their performance was off the charts, and none of the other guys could even do half of what her fund was doing. But come 22, that crashed. Now that is typically the case. No matter how good your research is, if you're not buying the frothy ideas in the bull market, you will tend to lag the index. Okay. Margin of safety, there's no mathematical formula as such. So yeah, it's a estimate. There's no precise number that intrinsic value is this much to the decimal point, and this is the precise discount ratio, and at this price only we'll buy. There's no such formula.
So as long as it is below intrinsic value is when you. Okay. And I have a small recommendation. I hope I'm not offending anyone, but I feel it would be good to give preference to the people who've come here in terms of questions. Also because I've seen that you get angrier as the...
So what happens is, see, it's not a question of getting angrier or so. See, the reason to cut out people is that there is a long queue. I don't want other people to miss out if one person is hogging all the time. That is one.
Fair enough.
And the reason why this format works better is that all the questions have come from all over the country, and Neil can combine the related questions and add nuance to it and things like that. So the discussion is more structured. I don't know whether you attend company AGMs, but otherwise people start reading out Urdu poetry and things like that. So we don't want those kind of things. So at least the bulk of the questions we can cover in the curated Q&A, and far more people get to ask questions that way.
Okay. Thank you, sir.
Hi, my name is Vaibhav, and I've been invested in a fund for almost 5 years, and returns are about 20%. Thank you for that. I have a little question, which might be a little bit stupid. I see in your IT services portfolio, you have added Infosys. And I just have a question that we already had HCL that had a very nice shareholder payout. You mentioned in an answer before that you added Infosys because the payouts are increasing. Was there a reason you added Infosys, or you didn't want to allocate more to HCL? That's it.
Theoretically, we could allocate more to existing companies also, but this also presented an interesting opportunity to enter. Otherwise, some of these stocks have been trading at quite an expensive valuation if you compare relatively. So there used to be a pecking order of valuation where TCS would be the most expensive in terms of earnings multiple, cash flow multiple. Then you would have Infosys, then you would have HCL Tech, TechM, Wipro. That list continues. But at some points in time, these valuation gaps do come in where you can see growth coming in, you can see company doing very well, and maybe market is probably not pricing it the way it was in the past. So if the opportunity was there, we would have taken the chance to buy another company also in the portfolio. I think it's the same opportunity. The target market that they have in terms of growth and sales will remain the same. It's a different way of approaching the same idea. So we build a few more companies in the portfolio with the same idea. And also we cannot invest more in the US tech-oriented companies anymore. So if you want technology exposure, this is another way of adding more tech exposure in the Flexi Cap fund also.
Okay. My second question and the last one is that you have a company in the name of United Spirits that has currently become debt-free. So I see in United Spirits, they own a cricket team, RCB. Do you think a cricket team will contribute to significant revenue in the near future or in the given future?
Yeah, so typically we refer to these as out-of-syllabus questions. So
I saw in the fact sheet.
Okay, so in arbitrage, it doesn't matter. What matters to us is the difference between the spot price and the futures price. The names of the companies don't matter at all. So it will be there this month, it could be out next month, or it could be rolled over. We don't have any fundamental view on the companies in the arbitrage.
Thank you.
Sorry guys, so we have to give the whole in 15 minutes. So we'll take the last few questions. So if we can make it a quick fire round, it'll be better.
Good afternoon, sir. I'm Parag Dore. My question is, China is having financial crisis like Evergrande, and also they are holding a large quantum of US. So what your take on that regarding the economic crisis? And second is, there is a lot of traction in biosimilar space. So what is your view on that? And
sure.
Yeah.
So about China, I don't know whether you saw the recent Bloomberg story that the stock analysts have been prohibited from writing anything negative about the economy or things like that. How much of data to trust and things like that? We don't have any investments in China. So we don't track too much. So probably you have a better understanding of Chinese economy, or I don't have any specific insights to share. Maybe you can take biosimilars.
Yeah, in biosimilars, the opportunity is very similar to that of the generic space. However, the product launches are not keeping in pace in the way they have been in the generic medicine side, because it's a fundamentally different approach for regulatory approvals that they have. So although companies have investments, we would rather do it in the basket approach only than pick a specific company doing only biosimilars.
Hi, thanks for the opportunity. So in the context of the AUM question that you alluded to, your peers don't have the constraints of not investing in an IPO, PSU, defense, EV. Everybody seems to be, they seems to be indifferent to the valuation. They don't seem to be holding cash positions at all. So could there be a quant framework on what kind of AUM can PPFAS sustain without diluting their principles?
So this number will depend on how much is the overall market cap of companies in India. So when I started my investing career, professional investing career, more than 20 years back, at that time TCS was not a listed company. Neither was LIC, neither was Coal India, neither were the recent startup kind of listings. So as the overall market grows, the AUM of mutual funds in India will also grow. Now, see, PPFAS is now going to be one among, I think, 47 or 50 AMCs, and some very, very big players are entering this space. Some renowned erstwhile mutual fund managers are coming back to the space. You have Geo BlackRock coming in. Bajaj Finserv has recently entered the mutual fund space. You have Helios of Mr. Samir Arora, which is coming back. You have Kenneth Andrade's Old Bridge coming back. Anyway, you have the current biggies, SBI mutual funds of the world, SBI, HDFC, ICICI, all these guys are there. Meaning, I don't know why people think that PPFAS will get all the money and we'll be the only managers in town. So,
because you have more principles than what we seem.
No. There are lot of good people in the industry whom we respect, and it's not that we'll be the only people getting all. So the overall market cap of India will grow. The overall mutual fund industry's AUM will grow, and with that, PPFAS will also grow. I don't see why we should put any financial limits on ourselves. So as I said, we service about 25 lakh clients in a 140 crore population country. Why should we worry about these things? There's ample room for all the asset managers, and it's not that we will keep getting all the money. The other people will also compete very, very fiercely in the overall space. Thanks.
Namaste. Thank you for opportunity. I would like to know your thoughts on group risk, like 30-40% of portfolio in companies of one group.
Pass. So, sir, typically we don't have 40% in one group. Which group are you referring to?
No, not about our fund, in general.
Okay. Yeah, in general, it's better to diversify across groups. It's better to diversify across companies rather than concentrate too much. Typically, the only group concentration that I would think happens is in the PSU space, where, especially on the debt side, where most of the borrowers are PSU companies and concentration happens there. But otherwise, I think we as a fund house as well as other fund houses in the industry look at the group concentration and don't go very heavy in a single group.
Yeah, in the beginning, weightage was not that high, but after the performance, this has become like 30-40%. So, just your thoughts on that.
No, I don't think we have any 30-40% group exposure across schemes.
No, I'm not talking about our fund.
No, you even outside in fact the small and mid caps companies will own as much as 150 and 170 companies. So they are very, very widely diversified. Even funds managing the large cap mandates will have higher weightages to the high weightage nifty companies. So they could have higher weightage to things like HDFC Bank and Reliance and SBI and things like that. I don't think anyone concentrates 30-40% in a single group. And again, if you are talking about some specific scheme in some specific fund house, we can't answer for them. You have to ask those people the question. But it's not a general industry practice. Most people have diversified investments.
Thank you.
Thanks. Good evening, everyone. I'm Abhishek Kumar. I've been invested in the Flexi Cap Fund for the last 3 years. Sir, initially while answering the question on the small cap funds, you were saying that you could go with a basket approach. And later on, when you were mentioning about CAMs, you were saying that you did not get a good allocation, so you had to exit it. So my question is, from a portfolio construction point of view, how do these under 1% allocation really move the needle when it comes to returns?
Sure. So at the beginning, Neil mentioned that we are the number 2 active scheme in the country. The number 1 is HDFC Mid Cap Fund, if I'm not mistaken, right? They are roughly around 52,000 crores. Again, Nippon's small cap fund is pretty large. So the CAMS IPO, if I'm not mistaken, happened a couple of years back. And at that time, there were enough opportunities to build large weightages in the smaller and mid-cap companies. And we were actually doing that. So we had big weightages in things like Persistent or Infosys. We had big weightages in things like IEX, CDSL, MCX, these kind of companies. So at that point in time, it did not make sense to have a very, very minuscule allocation to one particular company. But given the asset size that we have right now, the allocation in the small and mid cap space will be across a larger number of companies. So again, if you refer to Rukun's presentation on small caps, if you systematically weed out the bad companies in that space, that itself gives you a huge advantage in terms of generating good returns from that space. Also, I have to caution people here and the audience online is that when you take such an approach, or especially in the small and mid cap space, it's a probabilistic game. It's like betting always on heads when you know that heads is going to come 70% of the time. But 30% of the time, it will not be heads and you will lose money. But on an average, you will come out ahead. So when you have large number of companies and when you have more diversification, especially in the small and mid cap space, those companies are companies with monoline products where the product risk is there. They have less amount of management depth, so key person risk is there. Those companies are typically family run, who are first gen entrepreneurs, who will do unrelated diversification. So all sorts of things happen. So in our own journey, I have invested in a dairy company which got into constructing malls. I've invested in a education company which got into constructing large buildings for from a negative working capital. It went to very high receivables kind of business model. So those kind of things happen. So when you actually enter the small and mid cap space in a meaningful way, one has to be prepared for some of the companies not doing as well as per expectations. You have to look at the portfolio as a whole rather than looking at individual company performances. But your question on CAMS is valid. That was at a different point in time where we were able to invest, let's say, 5% in a single company. So then it did not make sense.
Thank you, sir.
Thank you.
We'll have just time for the last question because we have to give the whole. So
Okay. Thank you. Okay, so good evening, everyone. Thank you for the chance, sir. So my question is specifically related to the conservative hybrid fund. And you said that the merging of the scheme would not be possible with the new fund, whereas we have a precedence where the multi-cap funds were given an option to merge with the flexi cap funds. So what is the regulator's opinion with regard of why are they not comfortable with this? Why they do not want to merge them? Because see, my point is...
I'll repeat what Neil said.
Yeah.
He said converting the fund to another category was not looked at favorably. Merging, we will explore, as in when the new fund is running, we will explore it. We are not ruling that out.
Okay, understood. Thanks.
Thank you so much. Thank you everyone for taking the time out and attending with us. Neil, if you want to add some closing.
Thank you everyone for making your time out and spending the last 3-4 hours with us. Really appreciate for your patience. Thank you. Hope we see you all next year. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.